Good evening, members. Sorry for the delayed start of this program. So today we have a study circle session on issues in section 45 and 45A, 50C and 43AC. So we have a well-known eminent speaker of Bangalore and he is also known across the country, CA Naveen Khariwal sir. May I request Ethirajan sir to please escort Naveen Khariwal sir and please hand over the floor. Okay. I understand and believe that Naveen Khariwal is not a new person to us. He is very much known to us and across the professional community as well as the practicing chartered accountants. However, as a matter, we are supposed to introduce him to this gathering. So I will take a few minutes. The introduction goes around 4 to 5 pages. However, I'll make it short, sir. Yeah. So Naveen Khariwal, born in the year 1975, qualification BCom and FCA. Occupation as such, he is a practice chartered accountant and a partner of HC Kincha and co-chartered accountants, and also a partner in HC Kincha and Associates. Comes from the family of chartered accountants, father, grandfather, brothers, everyone. He specializes in direct taxes. Was also co-opted member of the Direct Tax Committee of ICI New Delhi. Currently member of Central Taxes, Corporate Laws and GST Committee of Federation of Karnataka Chamber of Commerce and Industries, Bangalore. Currently member of the Study Circle, Study Group of Committees of Chamber of Taxes, consultant in Mumbai. Was a member in Finance Advisory Committee of the Karnataka State Cricket Association, Bangalore. Was a part of nominated for Bangalore branch of SRC of ICI to be present before Honorable Justice R.B. Ishwar Committee for Simplification of Taxes, coordinator and moderator of JIGNAS, a one-day workshop on scrutiny, surveys, summons and search and seizures, speaker in various workshops, study circle meets and seminars and all. So he has been a speaker in various NIRC, WIRC, SIRC, Kolkata, almost all the places in this country. And also he will lead us in the international as well. Okay. So his presentations at the forums are Tax Association in Mysore, Indian Academy of College, Bangalore, took GMCS sessions for the members. Who would be the members, and KPCL research training centers at all KPCC offices, and Lab Bangalore's and Accenture, FKCCI, Chamber of Commerce, Industry of Spain, so many more. It runs through, and the best part of anyone's career would be the extracurricular activities that can take place. He is a keen and a devotee of cricket, I believe. Yeah, he represents colleges and universities matches and all legal in the legal fraternity with Karnataka State Cricket Association and represented cricket matches organized by Bangalore branch and income tax departments. So, with this brief introduction, I present you before you, Sir Naveen Khariwal. Thank you.
Coming deep straight away to the subject, because a lot of issues have been covered. 45 5A, very simple section to read, but believe me, each line or each word or each para or each comma will have manifold interpretations, multifold interpretations. Your interpretation may not be as my interpretation, similar to my interpretation, or my interpretation may vary with your interpretation. All these will have to be decided at the tribunal level only. Because assessing officer would make the addition, you would differ the calculation with your calculation, with my calculation. CIT appeals, no question of getting any relief with NFSC. So therefore, you will have to come down to the tribunal at Bangalore only. Now, why at all 45-5A? Why at all 45-5A, sir? Then we will go to this. Yeah. So if you see what was happening in this, about this joint development agreements before 31st of March 17 and after 31st of March 17. What was happening before 31st of March 17? I will not delve deep into the history, starting from Chaturvedi Kartadas Kapadia, Mumbai High Court, come down to the latest judgment. What was happening is the department was taking a stand that on the very day of entering to joint development agreement would amount to transfer. Then the cases developed. There were Karnataka High Court in the HB Jairaj, TK Dayalu, etc., etc. So everybody, cases were reopened based on TK Dayalu only. You see, long back, 20 years back itself, our senior chartered accountant of Bangalore, NCS Raghavan, he had given some 2-3 pointers of argument, how to argue a joint development case. Fortunately, he was not there to see that case. It fructified. What 2 lines he used to explain always in the real estate seminar, wherein Sri NCS Raghavan, Ashok Raghavan, Arvind Raghavan were there. Those 2 or 3 lines which you explained 20 years back finally saw the light of the day in December 2020 when Sheshashai Steels was delivered by the Supreme Court. When the Supreme Court made it crystal clear that not on the day of entering into joint development agreement, but coupled with possession, entering into JDA plus when possession is given, that would be there when joint development agreement, that would be there when 247.5, 247.6, read with 53 of Transfer of Property Act would be attracted. Late Sri NCS Raghavan, I remember, used to tell always, merely when you give merely entering into a GPA or merely allowing the developer to enter your premises is akin to a license as per section 52 of Easements Act 1882. These clear wordings resonated in my ears for several years. Now fructified by the judgment of Supreme Court. Unfortunately, he was not there to see his own lines being put in the Supreme Court judgment. Cut to 31st March 17. Now what? The message went clear. The message rang clear to the finance ministry of this country. They told, fine, we understand your problems, not on the day of entering to JDA, but in the year in which you receive constructed area, I will try to, give you some benefit when it will be taxed karke. But it's only for an individual or HUF. The law has developed first year of entering to JDA, then they told no, we'll go with your GPA. GPA is registered. Then they told no possession. Thereafter they told super built up area in the year you received, etc. It went on. After 1st of April 17, new section has been introduced by the Parliament. 45-5. Point number 1, applicable only to individual and HUF, nobody else. But whether it is all a benefit, you are going to come to know. They are telling, I want to give benefit to individual HUF. When you go to the section, you will find out actually whether benefit is given or not. So section applies only to individual and your HUF, that's all. Now what about it? If you see the section now, it is like this 45-5A. Notwithstanding anything contained in 45-1, this section overrides 45-1. So what you have to tell? Capital gain arises to an assessee. Who is that assessee? I told you, individual or Hindu undivided family. From the transfer of a capital asset. Meaning of transfer is well settled. You need not worry. It is in 2 in bracket 47. From the transfer of a capital asset, being land or building or both, the law is crystal clear. That means tenancy rights. That means leasehold rights. That means booking rights. That means all sale agreement. Nothing will come. They are telling rights are not covered in this. Only land or building or both. That's all. Capital asset. Transfer of a capital asset. Of what? Land or building or both. Under a specified agreement. Now, these are the new words here. Under a specified agreement, mean is also given. It says a registered agreement. So Balbir Singh many, Supreme Court judgment again. Balbir Singh many. Unregistered JDA cannot be acted upon. Supreme Court is telling, go back to 2001. Amendment was made in Section 17, Section 49 of Registration Act 1908, read with Section 53 of Transfer of Property Act. Any damn unregistered agreement cannot be acted upon as per law. Therefore, there is no question of any capital gains. Now, this section is telling there should be a transfer of capital asset being land and building under a specified agreement. What is a specified agreement? A registered agreement, basically. Then the capital gain shall be chargeable to tax. Stop. Transfer has happened in an earlier year. Capital gain only they are postponing. Transfer has happened in year 1. When you have, that is as per the usual definition of transfer. It may be 2 in bracket 47.5 or 2 in bracket 47.6, etc. So that entering of JDA along with your possession, etc. Transfer took place in that year. Only the liability to tax is postponed when? In the year in which shall be chargeable to tax as the income of the previous year in which the certificate of completion. What is certificate of completion, sir? For the whole or part of the project is issued by the competent authority, not received. Issued by the competent authority. Date of issue, date of receipt. And for the purposes of 48, the stamp duty value on which date? On the date of issue of the said certificate of his share being land or building. Mark the words of his share being land or building. Again I repeat, of his share being land or building or both in the project as increased by consideration received in cash shall be deemed to be the full value of consideration received or accruing as a result of transfer of capital asset. Fantastic. So third line, fourth line, individual or HUF, transfer of a capital asset, land or building or both under a specified agreement, that is a registered agreement. Capital gain will be chargeable when, sir? Year in which CC is received. So CC is what, sir? Is there a concept of CC in Bangalore, first of all? Is there something called a certificate of completion in Bangalore?
OC is there.
OC is there. So what you will tell? Section fails, computation fails. We are in literature. Lot of literature are there running into thousands of pages. This is the act, this is practice. Law and practice. Make the section workable. Make the section workable. Don't tell me there is no concept of CC. There is OC. Therefore section fails, computation fails, no tax. We are here to make you pay tax. Because the dream of the Honorable Prime Minister is what? Next, Modi 3. Yesterday's speech was there 2 days back. What he told?
International third place.
Third place anyway, developed economy, third place. Then, I am going to make plans for development for the next 1,000 years. What he told? 1,000?
Yes.
1,000 years. 43B class H here. That is only happening everywhere. 43B class H is what? Now he wants to take India to the third place, plus it's a $3.5 trillion economy. They want to take it to a $5 trillion economy. How to do? For example, Ram Temple, it's one project. He took that as a project, developed that. In the vicinity, 500 kilometers, everything is developed. There are hotels, there is tourism, there are lot of tourist places, etc. Buses, taxis, roads, etc. So, lot of taxes are coming. That project, take that as project, develop that. Ultimate goal is what? To see India as a developed economy. So, similarly, all this, each thing is being taken up as a project. So, go towards the development. 43B clause H, why? We'll do that also in half an hour in between, don't worry. Some members have told. Only practically and discuss nothing else. Come further now, come back to 45.5A. Under a specified agreement, capital gain shall be chargeable to tax in the year in which CC is received. So tell me, sir, CC is there or not? Concept of CC in Bangalore?
No.
There is no CC, as you told, there is OC. Probably CC when it comes up in Bangalore? Probably in Panchayat areas, CC is given.
Yes.
And BBMP issues OC, I think. So, but in Panchayat areas, I think you get CC. Or any CC is there or not? Pardon, sir?
When you are doing a commencement certificate.
Commencement certificate is there, sir, correct. But this is completion certificate. This is completion certificate. So, as per the act, there is a format of CC is given. But that CC they are telling, we are not going to issue. You get that signed by a chartered engineer, chartered architect, engineer, whatever, chartered architect. Then that becomes the CC. When you give that CC, that will be followed by receipt of OC. When I give that CC, it should be signed by a chartered architect.
Okay.
Then you are given the OC. So therefore, CC and OC may be synonymous terms. Nobody would be so adventurous as to go to the High Court and tell I received the OC, I did not receive the CC. Therefore, nothing is taxable. Okay? You can't make this section workable like this, unworkable like this. So therefore, as of now, we will tell that if the work is completed and being able to be occupied by the inhabitants of that place. You know, you are giving the place in habitable condition to the inhabitants. Probably that is beyond OC. So therefore, the year of OC, you will have to pay tax. There is no escape from tax, individual and HUF. So year 1, transfer. Year 4, year 5 will tell the receipt of CC. Fine, this example will continue. There will be no answers. You are going to get confused and more confused and more confused. Because the law as such, this is the law and there are no judgments for this. We can only give the views. You can have your own view. You stick to your view, don't divert from your view. Okay? So year 1 is the transfer. Year 5 we will assume that we are going to get the CC. Therefore year 5 you please tax me. In which the certificate of completion, understand, for the whole or part of the project is issued by the competent authority and for purpose of 48 stamp duty value on the date of issue of his share being land or building or both. What are you talking? Is this the way to draft the section? I am the landowner, Deepak is the developer. I am the landowner, Deepak is the developer. I entered into a joint development agreement with Deepak. I have given my land. For example, I gave my land. He gave me 40% constructed area. 60% constructed area he kept for himself. Okay, I gave a land. 40% constructed area is going to give me year 5. 60% of constructed area belongs to him. What am I doing? I have given him, how much sir? What land? What land? 40% of land always belongs to me. That land anyway belongs to me, but 40% of land always belongs to me. Because on that portion he is giving me the constructed super built up area. So 60% of land I have given to him. In return I am getting what? 40% of built up area. He is telling what will be taxed in the year of receipt of CC of his share, being land or building or both in the project. These are the wordings of the Act. So you may take a view, sir, I am going to take the guidance value of the land plus the super built area. Which I think this is not fair enough. That is not the way to calculate the capital gains. Although this is the mandate of the section. He is telling the stamp duty value on the date of issue of certificate. Yes sir. Of what? Of his share being land or building or both in the project. Suppose I am the landowner. Deepak is the developer. I have given the land. He is giving me 60% for 60% constructed area. He will give 40% of constructed area is giving me. That 40% of land always belong to me. Why should I pay tax on 40%? Is a question I am raising. What is your opinion? Section is saying, sir, of his share being land or building or both in the project as increased by consideration received in cash. No problem. You are going to get some refundable or non-refundable deposit, etc. Don't think cash means only cash and you will tell I received in check and again go to courts. You cannot, stretch the law to such ridiculous extents. If any, shall be deemed to be the full value of consideration received or accruing as a result of the transfer. So, you have to take the guideline value of the super built up area here. But the section is telling, take the guideline value of his share of land and building both. What is your opinion? Tell me. Yes sir. You want to tax only constructed area, super built area or land plus super built area? What is your opinion? What is your opinion, sir?
Building?
Building only. He is telling constructed area only.
Yes.
Because the land always belong to me. Therefore, telling 40% of constructed area, what I am getting year 5, I will offer a tax in year 5 the receipt of 6.
Because builder is only going to give him this.
Builder is only going to give him constructed area, super built area. So fair enough. I am never for a moment telling that don't pay tax. I am only telling that my calculation, your calculation may differ based on our individual interpretation. You are definitely in office share being land or building. Any other view, sir?
He is selling his land also.
Your opinion is selling his land also.
He is giving away his 60% land also. So there is a gain on the sale of land also.
Okay. So you mean to say what he's getting is 40% of constructed area, plus you want to add what? No, 40% of land, I tell you sir, 40% of constructed area is the consideration. Against what? What am I giving? I am giving him 60% of land I am giving. 40% of land always belong to me. So that is the reason I am raising that issue. So that is one grey area again. We will see the others. Now there is a proviso, sir. Provided that the provisions of the subsection shall not apply where the assessee transfers his share in the project on or before the date of issue of CC, and the capital gain shall be deemed to be the income of the previous year in which such transfer takes place, and the provision of this act other than the provisions of this subsection shall apply for the purpose of determination of full value of consideration received or accruing as a result of such transfer. What is your opinion here? So year 1 I told you transfer, year 5 I received the CC. What is the provisor telling? The provisor is telling I will throw you out of 45(5)(a) if at all you guys transfer your share, your interest basically, before the receipt of CC. I am going to throw you out of 45(5)(a). Suppose year 5 we are getting the CC, year 1 is the transfer, year 4 I transferred out my interest. He is telling shall not apply where the assessing transfers. 3 times the word transfer is used in this section. Transfer, such transfer, such transfer. So such transfer means which transfer? And the first transfer means which transfer? I told you transfer already 45(5)(a), one transfer was there. The first transfer, original transfer. Only the taxability was postponed to the date of CC. This proviso, what is it telling? 3 times they are using the word transfer. Where the assessee transfers his share in the project. It cannot be share in the project because I have not got the CC as such. It is only some interest. I have some interest. It is incomplete project. Even before I receive CC, I am transferring out. So that share in project means interest in project I am going to transfer out. Capital gain how to calculate? Shall be deemed to be the income of the previous year in which such transfer takes place. That such transfer is the year in which I transferred out my interest, or in the first year when there was a transfer. And suppose 8 years are passed now. First year transfer, 8 years are over. 9th year I am getting the CC. 8th year I transferred out. So if the original transfer, you will tell section is unworkable. Why? 148 you cannot reopen. New section also 148 ABCD etc. Up to 3 years, beyond 3 years, up to 10 years. You cannot reopen the case. So that such transfer is the original transfer or the transfer in the year of, just before the issue of CC. That year. Pardon sir? Second transfer. You will see this. So there are many issues. This is one other issue. Who is a competent authority? The guy who issues the CC. Competent authority is the guy who is issuing the CC. Means the authority empowered to approve the building plan by or under any law for the time being in force. Empowered to approve building plan. That means Deepak is doing this plotting. He took an agriculture land, converted that agriculture land. He made some 50 sites in that. 50 sites are there. You mean to say the person who is approving the building plan, there is no building on that site. So who is the competent authority to issue CC or OC for that site plotting business? This competent authority is what, sir? Authority empowered to approve building plan. Building plan means construction is a must.
Yes.
So this fellow is doing plotting business. Another issue for you. Food for thought. Next, specified agreement. Specified agreement means a registered agreement in which a person owning the land or building or both agrees to allow another person to come and develop a real estate project on such land or building in consideration for a share, being land or building or both in such project, whether with or without payment or part of consideration in cash. No problem. Then stamp duty value. Means the value which is adopted, assessed or assessable by any authority of the government for the purpose of payment of stamp duty in respect of the immovable property, being land or building or both. Adopted, assessed, no problem. What is assessable? Means the value adopted or assessed are assessable. What is assessable? Everywhere same word, 50C same word, 43C same word. 45 is same word. What is your opinion, sir? Maybe even for your sale agreements, which are going to be registered. Now, issue number 1, 45 is not retrospective, it's only prospective in nature, as held by 3 judgments of Hyderabad Tribunal. Shailaja's case, Agamati Ram Reddy, Adinana Reddy, Kumeta. All 3 Hyderabad Tribunal. Scope of section is limited, very simple, sir. Applies only to individual and HUF. So therefore, all other persons, including your partnership firm, company, LLP, etc., they are all excluded. So we are just telling there is no rationale between excluding all these guys. 45(5)A are not applicable to transfer of tenancy rights, leasehold rights, booking rights, rights in land or building, as held in a host of judgments. V.S. Chandrasekhar, example, it's rights in land or building. Devendra Ben, I borrowed Ahmedabad Tribunal, rights in land and building. So all these things. Then down you see Tejinder Singh is leasehold rights. Atul Puranik again leasehold rights. Date of transfer is frozen. Year 1 I told you transfer took place. Only thing is postponed is the liability to pay tax, which comes in year 4 example. So year of transfer is frozen. Issue number 1. You are going to take the stamp duty value or guideline value of the full consideration in the year of CC. Guideline value when you are taking? In the year of receipt of CC. But my indexation starts till the year of transfer. When there is transfer, my indexation stops in year 1. Year 4, you are telling me to pay tax based on the receipt of CC. What about the inflation between year 1 to year 4? I am not getting the benefit of that inflation. Please understand, index cost of acquisition is stopped in the year of transfer. When I pay capital gains tax in the year of receipt of CC, sale consideration, no doubt about it, my share of land or building, I take the guideline value, stamp duty value, absolutely no problem. Less index cost of acquisition, the indexation stops in the year of conversion, that is the first year, does not come to the 4th year or 5th year when I am getting the CC. What about the inflation between in the 5 years? What is your opinion? You will take indexation of 5th year or you will stop at the 1st year? First year you want to stop?
5th year.
5th year.
The stamp duty value you are taking on 5th year.
Stamp duty value are taking 5th year.
So transfer is deemed for 5th year.
Transfer is?
Deemed for 5th year.
Transfer is deemed for 5th year. No. Transfer took place in the 1st year. Only taxable is postponed to 5th year. The section is crystal clear about it. If you see there, go back. Capital gain arises to an assessee being an individual HUF from the transfer of a capital asset, being land or building or both under specified agreement. Moment you sign that specified agreement, there is a transfer, it says. Only the capital gain shall be chargeable when? In the previous year in which CC is issued. But as he told, this inflationary tendencies, or because you are taking the sale consideration in the 5th year, logically speaking, you should have given me indexation in the 5th year. These are all going to go to tribunal, sir, or high courts. Nothing will be done at your CID appeals level or at the assessing officer level. But you have a good case to fight it out. Based on the now logic. Date of transfer is frozen. Date of transfer has been defined in 2 within bracket 47. You know that transfer includes sale, exchange, relinquishment, extinguishment, or even that part performance of the contract referred to in 53A, etc. All that is the same definition, that is well defined. So therefore, there is no diversion from the definition of transfer. Only the instance of taxability has been deferred by it. If you take this example now, 45(2), where also the date of transfer is deferred. What is 45(2)? Conversion of capital asset into stock in trade. What is happening in conversion of capital asset into stock in trade? Same balance sheet. What was capital asset investment goes up, sits in current asset stock in trade. That's all. Nothing is there. The nature of the asset continues to remain the same. Only thing what was in investment will go and sit in stock in trade. So there, when is capital gain deemed to have arisen on date of conversion, but will be paid in the year in which stock in trade is sold. There you have two items of taxability, namely business income as well as capital gain. So the capital asset, when it is converted into stock in trade, capital gain is though taken to have arisen on the date of such conversion, taxability arises only at the time of sale of stock. Intention is clearly to tax the person at the time of consideration is realized. As on the date of conversion, only the nature of asset changes from investment to inventory. Nothing actually realizes on that day. Similar intention is there in 45(5)(a). As on the date of transfer, nothing would have actually realized. However, the property actually gets transferred on a date preceding the chargeability of tax. Now, period of holding. Period of holding, what to do? Whether it is short term, whether it is long term. Again, one more issue. Suppose Deepak purchased a property, say in November 23. In March 24, under a specified agreement, he is given that for joint development agreement. Within 6 months, he is given it for JDA. Specified agreement. That project will be completed after 6 years. So, at the end of 6 years, when he receives the completion certificate, as a landowner, you are telling me that he should pay tax as short-term capital gain or long-term capital gain? Short-term, because transfer is frozen. 6 months only, within the period of 6 months, he purchased the asset, he gave it for JDA. That project took 6 years to complete. At the end of 6th year, he got the CC. At the end of 6 years, he paid tax. So 6 years, you are telling me, the guideline value will be the stamp duty value in the 6th year, whereas the indexation will stop in year 1 itself. Or no indexation at all, you are telling, in the year of transfer. Short-term capital gain. This is one more issue. Now, the time lag between the acquisition and transfer of asset predicts whether the capital gain is short-term or long-term. In case of 45(5)(a), though the provision calls for deferment of tax on the date of actual transfer, still there is no such specific provision provided to clarify how the period of holding is to be computed. In such a situation, normal provisions of the Act would prevail. So 242(a), period of holding, reads like this. It gives the meaning of the term short-term capital asset as under. Short-term capital asset means a capital asset held by an assessee for not more than 36 months immediately preceding the date of transfer. Then you know, that amendment is made, third provision to 242(a) by Finance Act 17 with effect from 1st of April 18, that in case of an immobile property being land or building or both, period of holding is to be taken as 24 months immediately preceding the date of transfer. In the scenarios envisaged by 45(5)(a), transfer takes place at the time of transfer as defined in 247. Same Deepak's example, 6 months. Tax may be imposed at a later date when the CC is issued. For the purposes of capital gain, period between acquisition and transfer is to be computed. This may lead to weird situations. Assessee transfers a property under JDA to developer for development only after a period of 6 months of its acquisition. CC is issued say after 5 years of such transfer. Capital gain would be taxable after a period of more than 5 years from the acquisition, however only as short-term capital gain. So now I will have to do some tinkering or damage or interpret in my own style the section to get the benefit to my client. So this is the at first impact. This is how the section has to be read. Now, indexation also now we saw that. Now what we'll do, indexation benefit will be given to the extent of CII till the year of transfer. Fine. Suppose a land or building which was acquired by individual before 2001, you know, and the same is transferred for development under a JDA to the developer as on 31st of March 19, CC is issued sometime in April 25. Therefore, long-term gain arising to the assessee on transfer of asset will be chargeable in assessment year 26-27, while it appears that the index cost of acquisition will be computed taking the CII for the year 2020 only, since the transfer took place in financial year 19-20. Now, this is one alternate contention what we are telling. This is just a thought process, that's all. It has to be developed further when we are going to argue before the courts in case of any adverse stand taken by the assessing officer. This is based on my Karnataka High Court judgment on Rudra Industrial Corporation. Karnataka High Court judgment has come. What it says, this is in context of 45(2). 45(2) of what Karnataka High Court has told. You know that conversion of capital asset into stock in trade. Section says indexation stops till the date of conversion. Karnataka High Court is telling no. You have to give the indexation till what? Date of transfer. I am not telling, Karnataka High Court is telling. So I am relying on this judgment. Karnataka High Court is relying on logic. They are telling no, it is not the date of conversion. You go till the date of sale. This is a judgment of Honorable Karnataka High Court in the case of CAT versus Rudra Industrial Commercial Corporation. Issue was allowability of benefit of indexation in the case of sale of stock, which was converted to stock from investment. High Court observed as under. First, High Court is giving the meaning of index cost of acquisition. Then High Court is telling harmonious interpretation of the two provisions makes it clear as to how capital gain is to be taken into consideration. First, we have to find out what is the fair market value of the asset on the date of conversion. Fine, sir. And then to find out what is the market value of property on the date of transfer. Okay. So, in order to compute the capital gain payable, it is the market value on the date of transfer that is relevant. And in arriving at the market value of the index cost of acquisition, as prescribed on the date of transfer, is to be taken into consideration and not the date of conversion. Karnataka High Court is telling. In the instant case, the index cost of acquisition was 223 on the date of transfer. That is for year ending 1993. And the index cost of acquisition on the date of conversion is 161. Therefore, High Court is telling the AO committed a serious error in taking 161 as index. Appellate authorities have rightly interfered with the said assessment and have taken 223 as correct index cost of acquisition. So this is a one-off judgment, but in the context of 45 within bracket 2. So the same thing, because the same logic you need to apply for 45 also. The same logic. Following this judgment of ITAT, this Karnataka High Court, two other ITAT have given this judgment, Chennai Tribunal as well as Pune Tribunal. Ditto, they have followed the Karnataka High Court and given the benefit of indexation till the year of taxability of capital gain, even if the capital gain arose in an earlier year. In the case of 45-2. So this depends on your adventurous, how adventurous you are, or how your risk-taking ability, basically.
Not our clients.
Pardon, sir? Clients.
How aggressive.
Pardon, yeah, how aggressive it is. So this is, judgment is there. How convincing you are in front of the authorities. Now, move forward. Question is whether indexation is only up to the date of transfer or up to the date of issue of CC. Why we are giving our logic. Why it should be up to date of CC and why should it be up to date of transfer. Now in this case, Best and Crompton Engineering Court in tribunals given the correct judgment. CIA of the year of conversion into stock in trade has to be applied and not the CIA of the year of taxation. Fine. Now, what we are giving the logic is, consideration is frozen on the date of conversion. Under 45(5)(a), consideration is frozen on the date of issue of CC. Under 45(5)(a), when is the consideration frozen, sir? It is on the date of issue of CC. Because consideration is calculated based on the guideline value, stamp duty valuation prevailing on the date of issue of CC. Object behind giving benefit of indexation is to enhance the value of the asset by taking estimated rise in the cost of asset year by year as a result of inflation. If the indexation is restricted up to the year of transfer, as against the year of taxability, effect of inflation during the period between the year of transfer and year of taxability will be ignored. This may defeat the objective in granting benefit of indexation. Further, while the indexation during the aforesaid period is ignored, stamp duty value applied will be as of the date of issue of completion certificate. This also causes lack of parity. Therefore, it may be said that the cost inflation index of the year of taxability should be applied. Then what benefit you are giving me? In cases of JDA, then on the date of transfer itself, you know the guideline value will be less. After 7 years, the guideline value would have increased manifold. Have you come across a case where the first year, the date of transfer guideline value is lesser than the guideline value in future, more than the guideline value in future, 7 years hence? In all our cases, guideline value will increase. So therefore, this is the logic for taking the cost of injection or stretching the cost of acquisition, taking that as cost of index cost of acquisition till the year of CC, receipt of CC, because you are taking even the sale consideration also as in the year of CC. So to bring about parity, to bring about similarity, to bring out parity, we are relying on this case law. What is your opinion? This one opinion, we gave one opinion that if you want to stop it, so year up to year of transfer, it will stop, sir, your indexation and your taxability. Anyway, in the year of CC, sale consideration, year of CC, guideline value, I will stop the indexation in year 1 itself. That is one view. This is one alternate view. Cost of improvement is okay. Cost of improvement, will be incurred by the SSE on the capital asset transferred only till the date of transfer. Thereafter, all the improvements will be till the date of transfer will be given even if the capital gain is taxed after the transfer, and in any case property has in fact being actually transferred to the developer, generally no expenses should be incurred by the owner after the date of transfer on account of improvement of the property. Now specified agreement. The definition of specified agreement provides that the consideration shall be land or building or both, whether with or without payment of part of consideration in cash. Legislature has not specified the ratio. How much should be in revenue or how much should be in kind. They are basically telling it should be in kind. Along with kind, there may be some component of cash. If it's only a pure cash, you can't come under 45(5). You have to go under normal provision. Only when you receive major portion in constructed area, along with that revenue agreement, no problem, revenue sharing. There should be super built up area plus cash. You cannot have only cash. No. Why? Because going by the spirit of 45(5) and use of language, whether with or without the payment of part of consideration in cash. Therefore, consideration in cash cannot be more than consideration is kind. Now, what if the transfer is later than the date of issue of CC? Proviso tackles those cases which is before the CC. Suppose transfer takes place beyond the date of CC because of the dispute between the developer and landowner. What is your opinion? So he is telling year 5 CC has come. Transfer did not take place. There is a dispute between the developer and landowner. Transfer takes place in year 7, whereas in year 6 they have got the CC. What is your opinion?
CC only.
CC only?
Yes.
Transfer has not taken place. Transfer takes place in year 6. CC is received in year 5. When is capital gain taxable? Only on transfer. Only thing is 45(5), it is postponed till the date of receipt of CC. In this case, because of the dispute, unfortunately CC has come in an earlier year. Transfer takes place after the dispute is resolved. It takes place in a subsequent year. How to tackle?
Transfer is already taken.
Transfer already taken place, you are telling. Sir, in this case, that's what I am telling. Transfer is later than because of the dispute. Unfortunately, in this case, one-off case, we are envisaging a scenario. Transfer didn't take place at all. Work continued, but they did not agree on certain terms and conditions.
Okay.
So specified agreement probably is not signed. Example, specified agreement not signed because of some terms they did not agree, both developer and landowner. But the work continued, they got the CC, still the specified agreement is not ready. Meaning to say transfer takes place, sir, but only after the receipt of issue of CC. How to tackle those cases? Practically it may happen in future, it may be rare. I am not on the concept of transfer CC being received before the transfer being done before the CC or CC after the transfer. This is a case where transfer is later than the date of issue of CC. So here we are telling situation where transfer takes place only after issue of CC because of some dispute. So capital gain arises only on transfer of the asset. Therefore it cannot be said that on issue of CC capital gain has arisen to the assessee. So capital gain cannot be taxed at the time of issue of CC. Same has to be necessarily taxed only at the time of transfer only, because that time only it amounts to capital gains. In this case, the provisions of 45(5) will not be applicable and the capital gains will be taxed in the year of transfer as per normal provisions of the Act. However, it is to be borne in mind that the provisions of 50C, 43C referring to stamp duty valuation will be duly applicable. This is one view. Those cases I had postponed that. Why? Transfer took place earlier, then CC took place, subsequently we got the CC. In this case, what has happened? CC has come earlier, then transfer has come. So it's telling you can't, 45 away, you can't take the benefit now. Because you got CC earlier. When the transfer took place, you apply the normal provisions. In any case, it will be the guidance value only. Whatever you receive your constructed area, that will be as per your, that consideration will be as per the guidance value only. So these are all, hypothetical thoughts. Now the important thing, what if it is transferred before issue of completion certificate? What if its share of land or building is transferred before the issue of CC, provided that the provisions of the subsection shall not apply where the assessee transfers his share in the project on or before the date of issue of CC, and the capital gain shall be deemed to be the income of the previous year in which such transfer takes place, and the provisions of this act, other than the provisions of the subsection, shall apply for the purpose of determination of full value of consideration received or accruing as a result of such transfer. First 3 lines would have been enough, sir. I don't know why he is stretched. Provided provisions of this subsection shall not apply where the assessee transfers share in the project on or before the date of issue of CC. Enough. We understood. Because he has written the 6 lines, other 5-6 lines, it creates a lot of confusion. Now provisions of the subsection will not apply. Fine. So proviso will throw me out of 45(5)(a) if at all I transfer my share before the receipt of CC. Fine. Where the assessee transfers his share in the project, when did the transfer take place? Transfer had taken place already in first year, isn't it? Only the taxability is postponed. Now taxability, year 1 transfer has taken place. Year 4, year 5 I have received my CC. Even before receipt of CC, I have transferred my share out. So this second transfer, original transfer is there, second transfer is in year 4. So provided provisions of the subsection shall not apply where the assessee transfers his share in the project. Transfer his share when 4th year, this transfer meaning this transfer will be taxed in this year or this year no. Transfer has taken place here, already taxability is postponed only in the year of CC, provided CC is received. Before CC this will have transferred out. So that transfer will be year 4 or year 1 only. On or before the date of issue, and capital gain shall be deemed to be the income of the previous year in which such transfer takes place. Sir? Year 4 only. Year 4. Again indexation? You will take up to year 4 or year 1 only you want to start. And year 4 now this is normal provision or again how will you tackle now? 45(5)(a) only. There is not receipt of CC. Year 4 when you transfer out, you are transferring out before receipt of CC. You are not supposed to apply 45(5)(a). He is telling you apply normal provisions of capital gains. 247(5) or 247(6) read in section 53 of Transfer of Property Act. So what you will do now? How to calculate capital gains you tell me. 45(5) you cannot apply, sir, because even it is before the receipt of CC. So in the year in which you transfer, what he got? Same example. 40% of constructed area and I gave away 60% of land. So sale consideration of 40% of constructed area less index cost of acquisition of 60% of land. When I come to year 4, what is the sale consideration? Can I determine or not, or it becomes indeterminable now? Sale consideration, whether 50C will apply here? This is not a completed land or building, sir. Only my share in interest. It is incomplete, I have not received the CC. Therefore, what I am transferring is only interest in the project. It is not something which is complete. I can't find out 50C. 50C is what? Land or building or both. This interest in the project I am transferring out in year 4. So probably you are telling take the sale consideration. Sale consideration I take it as stamp duty valuation less index cost of acquisition. Which index cost of acquisition? Which one?
60% of the land.
60% of the land. So that year 1 also should I tax, or year 4 also should I tax, or how? That sale consideration year 1, does it become the cost share? 45(5)(a) is very simple, sir. 45(5) you want to apply the sale consideration is how to determine the guideline value of the incoming asset. 45 if you apply. Very simple. Guideline value of the incoming asset. When you apply normal provision you are calculating capital gains. How to calculate? Pardon, sir? Normal provisions is telling apply normal provisions of capital gain. That means to say year 1 transfer has no value for you now. Year 1 transfer took place. You are telling I will not touch that. Year 4 I transferred out. So it's telling rightly I will pay tax in year 4 only. Year 4 sale consideration of the guideline value of this my share which is transferred out less as she told 60% of the land cost whatever. What about year 1 transfer? That has already been taken place. So there are 2 tranches of transfer, only 1 transfer. 2 transfer. See, practical scenarios you want to face in future. The client cannot sustain for that long. He may tell, no, I want to dispose of my share. I can't wait till the year of CC. If he says, you should be ready for that scenario also. What is your opinion now? Somebody told 2 tranches of transfer. Somebody told 4th year. Yes, sir. What is your opinion?
2 transfers and 1 taxability.
2 transfers, 1 taxability. He is clear. 3 times they use the word transfer, but I will believe in 2 transfers, 1 taxability. Such a simple provision and memorandum tells, I am giving you beneficial provision, beneficial. I will not tax in year 1, I will tax in year 6 when there is huge increase in guideline value. How it became beneficial to me? Yes, sir. So these are mere opinions. Any other opinion? Any other opinion or any other mode of computation? You tell me. We have to be alert now. All these things will crop up now.
I have another question.
Yeah, please.
You transfer, like you said, 60% of the land, and later you transfer even your interest before you get your CC. You still hold on to the 40% of the land, right, in your name. What will happen to that?
Okay. No, 40% of the land. See, when I transfer out, what did I transfer out? I transferred out my share. My share. My share is what?
60%.
40% of the constructed area, not 60%. 40% of the constructed area which I would receive in future.
Yes.
So you cannot tell how to calculate that itself is a challenge. How to calculate that? You cannot tell it's indeterminable today because that is not complete. How to calculate that guideline value? What they are telling is if there is indeterminable because of JDA, apply 50D. 50D you have to apply. Gone are those days when you take all the stand now. George Henderson case, all that gone, B61 city, etc. Don't read literature today. They will reopen at 140 day ABCD up to 3 years from the end of assessment year, reopen. Blindly it will be reopened. So, in my opinion, you have to apply 50D. She asked that question, what to do correctly? Because it's difficult to calculate capital gains, how will you determine the guideline value of the interest in your share of land or building which is transferred before the receipt of CC? Something which is still incomplete. Meaning to say something which is incomplete. But you have to make the section workable. He rightly told there are 2 transfers, 1 taxability, whatever. You cannot avoid tax. So somehow you have to find out the guideline value. 50D is telling that. Wherever consideration is indeterminable, you please take the guideline value. Somehow we will have to determine the guideline value. Can I determine only the guideline value of constructed area, sir? So as I told, I am not giving land. Land belongs to me. What I am getting is the super built area. Is it possible for me? Is there a mechanism to determine the guideline value of the constructed area?
Percentage of completion?
No. Percentage of completion does not come to me, sir. The developer. I am not bothered. ICDS 3, ICDS 4, AS 7, AS 9. Out of these 2 will apply to developer, 2 will apply to landowner.
Yes.
Landowner, I am crystal clear. POCM method, he will apply. I am only, what I am doing. Share of constructed area, 45 is telling in the year in which you receive CC. Please, whatever constructed area receiving, please take the guideline value of matter ends. Is there a mechanism to get the guideline value of the constructed area? Sans the land. If you take the section as a whole, he is telling office share of land and building. Then you can take that suggestion also. Contention also. Land and building, both you can tax. You will have tax both land and building, then reduce the cost of land again. Because entire land you are taking there up. That calculation again you have to see. Three types of calculation will come. Choice is yours. We don't know what is the stand of the department in future. You have to, when the claim comes here, necessarily give 3 types of calculations. These are the calculations. Keep it in the file. Whichever you say, we will take the risk and file it off. Department stand, I don't know. Because not a single case under 45(5)(a), as of today, any additions are made or anything is pending before the appellate authorities. Now it would be taken up. This is the problem. So, very simple section, but you see how many interpretations are there. If there was a single judgment, I would have given a clear-cut answer. Because there is no judicial precedent which can back my view. So therefore, I can only give you the calculation. This is calculation 1, calculation 2, calculation 3. We'll have to be careful, understand all the calculations and see which is, there should not be any tax evasion here basically. Whichever calculation you say, you do it in full confidence by having your own logic and explaining that. If this year this transfer is frozen, I am taking this cost of indexation, etc. You explain that and then take. What about 54F? Year 1 is transfer. Year 6 that CC came. Year 6 I will pay the tax. What is 54F telling? You can claim that. But when from the date of transfer took place in year 1. Tax I am paying in year 7. How can I claim that 54F? They will tell already over, time over. So again I have to stretch that again. I will claim 54F and stretch that again. Why? In context of 54EC, 54EA, 54EB, there is a circular which says that in the year in which you receive the consideration, that time only you can claim 54F. Based on that circular, I am going to fight this case again. Else, there is no chance. They are telling 1 year before the date of transfer, or 2 years from the date of transfer, or 3 years from the date of transfer, purchase a land, construct a building, etc., etc. You know that. 3 years are long gone by. So 6 years are over. How to claim, sir, 54F? I never received the consideration at all. Year 1, how can I claim? You are postponing my consideration to pay tax only in the year of receipt of CC. Where the question for me to claim 54F? I will first time claim the deduction in year 6 only when I receive the CC. By that time you tell, no sir, 3 years time limit is over. You cannot make that investment. He told 40% of constructed is giving me super built area. 4 houses I will get. Example. I am going to get in year 6. I want to claim 54F, very good. But law is telling that time limits long gone, long expired. How to do? So therefore, I have just given you this, I will just tell you, yeah. Where is that? Here it is. There is a case law. In the context of 45(2), where an investment is converted into stock in trade and the transferred, the CBT has issued circular number 791 dated 2nd June 2000, which came out in context especially of exemption provided in 54EA EBEC. That means conversion of stock in trade into capital asset in stock in trade, very year of conversion. Conversion itself is amounts to transfer. But taxability postponed to the year of sale. Similarly, here is telling in the year of sale only, you claim 54F. Although that stock is liquidated or sold after, say, 5 years. In this circular was provided for the purposes of these exemptions. Date of transfer for the purpose of this circular has to be taken as the sale of transfer of stock in trade. So beautifully he has given that relief. Sale of transfer you take, not date of conversion. Again it's backed by a judgment. Ranchi Tribunal, Ranchi Bench, Rajesh Kumar Adakya, relying on CBT Circular 791 dated 2nd June 2000. Date of transfer shall be the date on which stock in trade is sold or otherwise transferred by assessee and not on the date of conversion of capital asset into stock in trade. Further, special bench of ITAT Calcutta in the case of Octavius Steel has held that on conversion of capital asset into stock in trade, there is no profit as no one can make profit out of himself. Therefore, in view of the CBDT circular and order of special bench of Calcutta bench of tribunal, in the case of Octavius, I have no hesitation to hold that the AO was also not correct in denying benefit of 54F of the Act to the assessee on the ground that residential flat was not constructed after the date of transfer but along with the saleable flats. Again, one more Ranchi Bench Tribunal judgment I have given, Nisha Saravgi. This all will be uploaded, this presentation, don't worry about it. It is to be noted that the circular was specifically for the purposes of investment mentioned under 54 EA, EB, EC, etc. However, taking a cue from there, Honorable ITAT has allowed the extended time limit for the purposes of investments referred to in 54F. We'll have to wait and watch now, whether board comes out with a notification, etc. So there is no mechanism for reference to a valuation officer here, as per your 50C2, etc. claim, where you can claim before the assessing officer. There is no question of mechanism for a reference to a valuation officer under 45(5)(a). Now, 49(7), cost with reference to certain modes of acquisition, 49(7), where the capital gain arises from the transfer of a capital asset being shared in the project in the form of land or building or both, referred to in 45(5)(a), not being the capital asset referred to in the proviso to the said subsection, then the cost of acquisition of such asset shall be the amount which is deemed as full value of consideration in that subsection. Yes, sir. Tell me what question you have on 45(5)(a) or any suggestions you have. What suggestions you have?
Part transfer.
Part transfer, very good, sir. He is telling now, very interesting, CC has come, or part CC has come, part project CC has come. Section is telling what? Even in part CC, entire full transfer will take place. Or for the portion of part CC, I will apply 45(5)(a). Part CC has come, I will apply 45(5)(a). And for the other, I am going to keep quiet until I get the full second CC or whatever. What is your opinion? What is your opinion, sir? Reasonable construction? This is a reasonable construction of law. He is telling part CC only I have got. So, proportionately I will pay tax. Proportionately I will pay tax. I will wait for the next CC, second CC to come. Good enough, sir. Reasonable construction of law. Any other point, sir, before we break for tea? We'll do some issues in 50C and then 43B clause H. 43C is a replica of 50C. 43CA, if you have understood 50C, replica of 50C, 43CA, nothing to worry. Fine, sir, we'll break for tea then. 10 minutes you can go and come back.
At the canopy.
Yes.
Yeah? Please.
So we'll continue with the session. Nothing to worry, sir. What we have given is only opinions. There are 1 or 2, 3 types of calculations. But what safely you can do is, without any worry, you can follow these 3-4 computations. Nothing will happen. 45(5)(a) is very clear section. What it says, if you are an individual, HUF, I am not going to collect tax in the year of transfer. I will postpone it till the year you receive the CC. When you receive in the year of receipt of CC or OC as the case may be, what I am going to do, I will take the guideline value of your share of land or building as the case may be. Then you calculate capital gains. So one opinion is you can decide whether you want to include share of land or building, means you have to take entire share of land or building, even though that land is always belongs to the landowner only. But even if you were to decide, no, I am not going to take that 40% of the land, as the land was always with me, definitely my hunch is you will get a good relief at the High Court or terminal level. There you cannot be disturbed. I am going to pay tax, but not on my portion of 40% of the land. You are going to get good relief based on that logic. Secondly, even based on our logic of cost inflation index, can I stretch it up to the year of conversion or up to the year of the receipt of CC or up to the year of transfer? Based on the case laws rendered by Karnataka High Court in 45(2). So you can try to stretch it up to the year of receipt of CC, because based on parity, based on reasoning, when you are taking the stamp duty valuation in the year of receipt of CC, you ought to take even the cost inflation index based on inflationary tendencies up to the year of CC. It depends on how you can convince the authorities. in my opinion, you should be able to manage the, manage to convince the authorities. But even then, the third opinion would be, if you are going strictly by the letter of law, share of land or building, I include both land or building both, then I think that would be unfair to the assessee as such. Because the assessee is the owner of 40% of the land, he never transferred that land out at all. You are getting your 40% of constructed area after 5 years or a year of register of CC. At that time you are telling me to pay stamp duty value of the land which I never transferred, which is, I think, to that extent it would be unfair. Again, what Deepak explained, you can take that stand also happily. When the proviso applies, when the proviso will apply, sir, only in the year before the CC you have to sell your share of land or building. Fine. In the year in which you sell, that is say year 5, year 6 of received CC, that year you are offered capital gains and finish it off. Not an issue. You take the fair market value or the guideline value of the sale consideration and then calculate the cost inflation index. These are all, so to say, these are all, within the legal boundary of the section, basically. I am not being adventurous, then I am not going to take the cost inflation index or the period of holding, etc. based on the case laws or based on the board circular in the case of 5450F, rendered in context of section 45.2 or even that circular which is rendered in the context of deduction claimed under 54EA, EB or EC. Fine. Come to now, some members were telling me, you please discuss a few minutes about 43B clause H also. 43B clause H is crystal clear, sir. Point number 1, it is applicable from 1st of April 24. Meaning to say applicable from assessment year 24-25. Finance Act 23 section is already implemented and passed. No question of any confusion. Number 2, there is a buyer, there is a supplier. Understand carefully, there is no question of any confusion. Sanjay is the buyer, Deepak is the supplier. Now Sanjay is the buyer, Deepak is the supplier. 43B clause H, point number 1, applies to every damn assessee, whether under audit or not under audit. Don't be under the confusion that it applies only to persons under audit. Sorry. 43B clause H applies to all. Okay. Now Sanjay is a buyer. Sanjay may or may not be registered as an MSME. Okay. Don't get confused. Sanjay may or may not be registered as an MSME. But the supplier, Deepak, has to be mandatorily registered as MSME. That means what? Micro enterprise, small enterprise, not medium. If this fellow is a medium, Sanjay need not pay him within 15 or 45 days. So therefore, point number 3 is, Sanjay is a buyer, fellow may be registered, may not be registered MSME, don't worry. But Deepak has to be mandatorily registered as a MSME, meaning to say as a micro or small enterprise. What is the meaning of micro or small enterprise? As per section 7 of MSME Act 2006. And then registration is there, section 8. That definition is there. Who is a micro, who is a small? That 1 crore, 10 crores, 10 crores, 50 crores. What is that? Turnover as well as investment in plant and machinery. Turnover and, it is not R, and investment in plant and machinery. Turnover, investment in plant and machinery. That is, I told you, the meaning. Therefore, Deepak is a medium, he is outside the MSME Act, therefore Sanjay can make the payment beyond the due date. 43B clause H is saying what? Any buyer has to make payment within the timeline specified in section 15 of MSME Act. When I go to MSME Act section 15, it says, please make the payment within 15 days or 45 days as the case may be, where there is agreement. If there is no agreement, within 15 days. Now 15 days and 45 days from when? Is it from the date of invoice or from date of delivery of goods? 15 days, 45 days, how to calculate, sir? Whether from the date of invoice or date of delivery of goods? It is from date of delivery of goods. 15 days or 45 days. Again, agreement. Should the agreement be on stamp paper or should not be on stamp paper?
Purchase order.
Pardon, sir?
Purchase order.
Not required. Not required on stamp paper, that means. He is telling purchase order also can be an agreement. For heaven's sake, there is a date of transaction, there is date of receipt of goods or delivery of goods. Then don't send a mail for agreement, sir. These dates are passed by, then don't tell there is an agreement. Don't make an agreement after these dates in a mail. You send a mail also. Mail should be before these dates. We don't know. In the practice, okay, I send a mail and for heaven's sake, see to it that mail printout, let it be signed by both buyer and supplier. Both Sanjay should sign, both Deepak should sign. You cannot tell only he signed or he signed. That agreement should be before these 2 dates. Okay? For every transaction you want one agreement or one agreement is enough? One agreement is enough, sir? One agreement is enough. Again now, you have to advise the clients immediately today. Go right now, tomorrow. Tell them to shoot mails to all your creditors. Please shoot mails to all the creditors. Telling what? Please give me your MSME certificate. You please tell me, are you micro, small or medium? Then you have to tell them about all these purchase bills which are in, say, February 15th also I am not bothered. February end, because that 45 days. And March anyway you will have to take, prepare a column. What is the date of purchase bill? What is the date of payment? What is the date of deadline as per MSME Act and actual date of payment? So that you will have to find out. Because when you give your audit report, Form 3CD, Form 3CB, clearly 43B clause H, you will have to make a disclosure or you will have to make the addition also in case it is not paid within the due date. If it is not paid within the due date, please make the addition. Don't worry, it is not a permanent disallowance. It will be allowed in the year of payment. Nothing to worry about it. Allowed in the year of payment, such that if Sanjay's income now, he did not pay 1 crore. 1 crore you know he is not going to pay. Possible you pay advance tax also in March. Anyway it will be disallowed. He cannot pay 1 crore. Under business income, under 28 it will be disallowed. Next year, that 1 crore will allow as a deduction. Next year he may have loss. That loss also you carry forward under section 72 as business loss to be set off for, carry forward and set off for 8 years. 43B clause H. Then there is section 16, there is section 23 of MSME Act 2006. Section 16 is telling what? There is delay by Sanjay in making payment to Deepak. Deepak can use that MSME portal. Section 16, 3 times bank rate. Monthly rest RBI, 3 times bank rate. Section 23 of MSME Act is telling, even if Sanjay makes interest payment to Deepak of 3 times bank rate, it is not at all allowable as a deduction in Income Tax Act. Even if he has paid interest, it is not an allowable deduction, section 23. 43B clause H. What else you want?
It applies to only traders or manufacturers.
Very good, sir. Now, micro and small I told. I use the word micro, small. One more word you have to see in the act. What is that? The word called enterprise. Meaning of enterprise. Take micro, add enterprise. Take small, add enterprise. What is an enterprise? Who is an enterprise? Enterprise is an undertaking. Is an establishment. Is a business concern who carries on manufacturing, production of goods or rendering of services. That's all. Manufacture, production of goods, rendering of services. Engaged in manufacture, engaged. What do you mean by engaged? Continuous activity, not a stray activity of manufacturing. You are doing a continuous activity, distinct activity. So, continuous activity basically. So, manufacture, production of goods or rendering of services. So, by default, traders are out, retailers are out.
Medium business.
Yeah?
Medium business.
Your wholesalers are out. Nothing to worry. So if the supplier Deepak is a manufacturer, he has to make payment. This fellow is engaged in production of goods, similarly rendering of service, like that.
You mean to say in your given example,
Yes, sir.
if this person is a manufacturer,
Yeah.
then only applies if he is a trader.
Applies to him, buyer.
Ah.
Suppose this fellow is a trader. He is going to give you MSME certificate. It says MSME trader. In June, in 21, the traders went to madam because for COVID period. They told, please allow us to be registered for MSME. Madam told, I will allow you to register on MSME for only what? For limited purpose of priority sector lending, nothing else. So although you are registered as a trader in MSME portal, yet you are not getting any other benefit under MSME Act 2006. There is an office memorandum issued by under MSME Act. Clearly stating traders are recognized only what? For registered only what? For what? For priority sector lending, nothing else. You are not entitled to any other benefit under MSME Act 2006. What is your doubt?
So in
Everything is crystal clear, sir.
No, in nutshell, if you are not, if you are not paying the manufacturer, then the disallowance alive. The question of
Yeah, if you are not paying them within time, 15 days or 45 days.
No, to the manufacturer. If he is a manufacturer and supplying you goods, then the question of disallowance arises. If he is a trader, you are buying from trader and you are also a trader buying and selling, then the question of
Does
disallowance
not arise.
No, that's not saying.
Anything else, sir?
As you told,
1 second, sir.
as you told that it's issued as goods or the delivery of the goods. but it's still lying with the transporter. We have not yet released from.
How many days it will lie, sir, with the
No, just
transporter?
to understand, yeah. Suppose 15 days later.
No, correct. All these tactics will not work in department.
But
How do you
15
prove, sir?
days
The moment it reaches the transporter, you get that alarm.
Yeah, that's what.
Then from the transporter to your premises, how many days it took? All this to be proved on the facts of the case. He's telling some 5-10 days, I'll try to get relief there.
Yeah, 5-10 days.
5-10 days I'll try to get relief there. You'll have to prove that the delivery of goods done within 1 week after it reached the transporter's warehouse.
Sir, if the manufacturer also does some trading.
Manufacturer? Fantastic, sir. He's telling you are a trader as well as manufacturer. Apply 43B clause H. Apply 43B clause H. I can't tell which goods you transferred, which is goods is manufactured, HSN code, this of trader, this of manufacturer. I have no time.
So if a trader is giving the service of installation in that case,
Is it rendering of services or not?
one of the case, example,
What comes in the MSME certificate?
so trader,
Huh?
trader,
I will not do. You are a trader, that's all. I keep quiet.
even the installation bill is there, you know.
I am going based on the certificate, sir. I can't go in the trader. You are telling me what now to do the audit. Otherwise, take up that as special assignment. Any other questions, sir? MSME, you'll have to apply right now. Anyway, institute will apply your tax audit seminar. I'll give you a beautiful disclaimer. Be happy. Like your class 44. Class 44, Deepak gave me a beautiful disclaimer. I circulated all over India.
MSME certificate is.
Pardon, sir?
MSME certificate is amended in between the year.
MSME certificate amended in between the year. Beautiful. He's telling you as manufacturer up to 9 months, sir. So a manufacturer can be changed to trader now.
Yes.
Are you getting the certificates now? Can it be changed?
Yes.
On the date of transaction, you see, sir, what were you? On the date of transaction where your manufacturer apply, you can't, there is no way out here. Any other questions, sir, or any tax planning?
You have to tell.
Pardon, sir?
You have to tell. You are more expert than others.
Pardon, sir? Disclaimer will come only during audit time. Audit time will give a disclaimer. Suppose they are not willing to give you, now the trade creditors, for example, there are 100 trade creditors, okay? Sanjay has circulated, he has shot a bill to all his trade creditors. Out of 100, imagine 80 of them did not respond at all. What can you do, tell me? What I can do, tell me as his chartered accountant. Or out of 100, when he has shot a mail to all of them, 100 of them will reply. I will take a positive, everybody will reply. Out of 100, 50 may tell we are traders based on MSME certificate. So 50 we are safe. Another 20 will tell we are manufacturers. Another 20 will tell we are not registered on MSME Act.
Okay.
Something like that. So based on that only, or something called as materiality. Out of 100 traders, who are the top 50 example, top 20. Something I will do materiality. I can't check each and every creditor. How can I check each and every creditor?
Yeah, thousands of creditors.
Thousands of creditors are there, example. How can I check? There are 100 creditors now. How can I check? See, PAN, GST, everything is linked. PAN, bank, Aadhaar, GST, etc. MSME portal is still not linked. Once it gets linked, then there is no way out. Easily I can find out who is MSME, who is not MSME. Today I can't find out are you MSME or not. And today, standing today, nobody can cancel MSME certificate. It is not online portal. Many of them are going to cancel. They are trying to get it cancelled because orders are getting cancelled. 5 seminars I have done, sir, already. 6th seminar on MSME will be on 19th for the Mumbai Chartered Accountants. Thereafter, I can get much more tax planning. 5 seminars I finished. 6th seminar will be for the Mumbai Chartered Accountants, especially only on this topic. 1.5 hours only on one section. Come back to 50C, sir. So 50C, old section, we will only go to the issues. So 50C1, consideration received or accruing as a result of transfer of an assessee of a capital asset, being land, building or both. So 50C will apply only to land or building or both, does not apply to interest. Meaning to say all interest or like your leasehold rights or transfer of booking rights or transfer of tenancy rights, etc. Is less than value adopted, assessed or assessable by any authority of a state government for the purpose of payment of stamp duty. State government they are telling. What about union territory? So there you are telling I will sell below guideline value? Not applicable. You are telling authority of a state government. Okay. Come down, for the purpose of payment of stamp duty in respect of such transfer, value so adopted, assessed or assessable shall for the purposes of 48, that is for calculating capital gains, shall be deemed to be full value of consideration. Very simple, nothing to worry. Now first proviso, let us go to the provisos. This first proviso is inserted by Finance Act 16 with effect from 1st April 17. Provided that where the date of agreement fixing the amount of consideration and date of registration for the transfer of capital asset are not the same, the value so adopted, assessed or assessable by the Stamp Valuation Authority on the date of agreement may be taken for the purposes of computing full value of such transfer. But this first proviso is subject to second proviso. We will go through that, then we will discuss. Provided further that the first proviso shall apply only in a case where the amount of consideration or part thereof has been received by an account paid check or bank draft, etc. on or before the date of agreement. So what is the first proviso? He is telling date of agreement and date of registration, both are not same. Very good. There is a timeline or time lag between date of agreement, date of registration. So what to do is telling, you please take the stamp duty value prevailing on the date of agreement. Suppose 3 years are over, sir. This is the date of registration, this is the date of agreement. So you take the stamp duty value prevailing on the date of agreement when provided any part of the sale consideration, it may be even ₹1 rupee, maybe even ₹1, sir. Any part of the sale consideration is received through banking channel on or before the date of agreement. Have you understandable, sir? Issue number 1. Suppose the date of that sale deed, why this provision has come? It is to avoid all backdating, antedating, backdating. So suppose this agreement is registered and I have not received a single rupee in check. I received 10,000 in cash, but agreement is registered, but the transfer has taken place after 3 years. What will you do? Wouldn't you go for the stamp duty prevailing as a date of agreement? Because the agreement is registered, sir. So in my opinion, I never had an intention to defraud the government. I got the sale agreement registered, but I have got advance of 10,000 in cash. So the guideline value prevailing on the date of sale agreement is 1 crore. 3 years down the line it is 2 crores. But that sale agreement is registered, but unfortunately I didn't get a single rupee in through bank account. You want to give benefit, but you are making such conditions. Proviso is trying to give me a benefit, but proviso is not helping me. That is first issue. Second issue is, suppose date of agreement, date of registration, the date of agreement is there. On or before the date of agreement, I didn't receive any amount by check. But after 10 days I received. Today the agreement took place, sir. After 10 days I received the money through banking channel, some advance, 10,000. Then registration is done after 3 years. In that also you are telling, you will not give me the benefit of the sale agreement. Sale agreement I entered into, sir, today. But I didn't get any money through check on the date of the agreement, but I got after 10 days after the agreement. What is your opinion?
Check payment validates the agreement.
Check payment validates the agreement is telling. Or you take the stamp duty guideline value prevailing on the date of check at least.
Yes.
What is the purpose of the amendment? Agreed. On or before the date of agreement, I have not got any money by check. I received after 10 days. What do you want to do? Or I have also received cash on the date of the sale agreement. I have accounted in my books of account. It is accounted in my books. And at the time of registration of the sale deed, I have made the entire payment in check only. Balance payment in check. Even the seller is accounted, even the buyer is accounted. These are all only issues. So, but the agreement, the first proviso is subject to second proviso. Very simple is telling. There is a date of agreement, sale agreement, date of registration, sale deed and sale agreement. If at all you receive any portion, any part of the sale consideration by way of check on or before the date of agreement, I will take the stamp duty value prevailing on the date of sale agreement. That's all.
See whether the agreement should be registered or unregistered.
That is the $1 million question. Nowhere it says agreement should be registered. So that agreement also need not be registered in my opinion. If you are getting the sum by banking channel, it is enough to make this proviso workable. Agreement need not be registered.
Generally, it is not registered
Generally also it is not registered, he says.
in the real estate business.
But I received money through banking channel only, on or before the date of sale agreement. Okay, sir? Now, third proviso. I will give you some case laws also which are in favor of the appellant on all these provisos. Sir, the third proviso, provided also, this is applicable from Finance Act 18, applicable from 1st April 19. Provided where the value adopted, assessed or assessable by the stamp valuation authority does not exceed 110%, substituted for 5 by Finance Act 20 with effect from 1/4/21. Today it is standing at 110. Of the consideration received or accruing as a result of transfer, the consideration so received as a result of transfer shall for the purposes of 48 be deemed to be the full value of consideration. That means they are giving the benefit.
10%.
The difference is only 10%. 110% of what? Stamp duty guideline value or actual sale consideration? Of actual sale consideration. Of actual sale consideration. This is when, sir, applicable from? 18. 1st April 19. We have got judgments now, which is telling this proviso, although has come in statute books with effect from Finance Act 18, that means with effect from assessment year 1920, it is applicable from the date of inception of section 50C. So use the benefit. Today, if any case law is there, 16, 17, 15, 16, although this 110% has come now, even for 12, 13, 13, 14, 14, 15, you can use this. The difference is less than 10%, no question of invoking 50C. Case laws are there. They are telling this is curative, this is beneficial provision. This is plugging a curative benefit, curative amendment. So this will go back from the inception, go till the, will be available from the inception of 50C. 50C came long back in 2001. I will make applicable it from 2001 itself or 2003 itself, whatever. Although this section came in statute only from, similarly, sir, this 1417, first proviso, Finance Act 16, applicable from 1st April 17, this date of agreement and date of registration, this also can go back from the date of inception of 50C. There are judgments for this. Beneficial provision, we'll give the judgments. 50C2, very interesting section. Without prejudice to the provisions of 1, the assessee claims before the AO, you have to claim, sir, before the AO, that the value adopted by stamp valuation authority exceeds the fair market value of the property. You have to claim before him. No, your stamp valuation authority is more than the fair market value. Moment fair market value comes, sir, what should strike you? What should come in your mind? Moment fair market value, what is used? What should come in your mind, sir? Valuation report. I want valuation report. Fair market value means prove valuation report. Take the valuation report, go before the assessing officer. Sir, stamp duty guideline value is 1 crore. Valuation report is saying 80 lakhs. Put a claim before him. Then, the value so adopted, assessed or assessable by the stamp valuation authority under subsection 1 has not been disputed. One more condition is there. Has not been disputed in any appeal, reference or revision, and no reference has been made to any authority, court or high court. Then the AO may refer to valuation of capital asset to valuation officer. So he is telling, first of all, stamp duty guideline value was 1 crore. But as per the assessee, sir, I have got fair market value. There are some electric wires there, etc. There is some school there. There is a nala there, etc. So that fair market value is only 80 lakhs. Take that valuation report, make a claim. You have to make a claim before the assessing officer. Assessing officer will take that claim. He will tell and refer the case to a valuation officer. See the word there. The assessing officer may refer the valuation of capital asset to a valuation officer. Means what?
He may accept also.
Sir?
He may accept also.
There are case laws which says the may shall be read as shall. Otherwise they are telling the section itself becomes redundant. Anytime assessing officer tell no, 80 lakhs is not correct, 1 crore only is correct. Then what is the provision? What is the use of the section? Then it becomes redundant. Therefore section is telling, case laws are telling, the word may will become shall. He has put a claim, refer to VO. Refer to valuation officer. That's all is your job. Move forward. And where any such reference is made, who has made the reference? The provisions of Wealth Tax Act would apply. AO will make provisions reference to your valuation officer. Provisions of Wealth Tax Act would apply with necessary modification to such reference as they apply in relation to reference made by assessing officer under 16A1, that was reference to valuation officer in those days when Wealth Tax was there. So they are giving the meaning of valuation officer. Valuation officer means as per Wealth Tax Act. Then for the purpose of this section, explanation 2, expression assessable means the price which the stamp valuation authority would have adopted or assessed if it were referred to such authority for the purpose of payment of stamp duty. Now 50C3. Subject to the provisions of subsection 2. What is subsection 2? I made a claim before the assessing officer, who in turn referred the same to valuation officer. Where the value ascertained under subsection 2 exceeds the value adopted, assessed or assessable by the stamp valuation authority. So 80 lakhs is as per me, sir, fair market value. 1 crore is stamp duty guideline value. Now the VO made it how much? Exceeds the value adopted or assessed by the stamp valuation authority. Made it 1.2 crores. 80, 1 crore, 1.2 crores. Value so adopted or assessed by such authority shall be taken as the full value of consideration. Value ascertained under 2 exceeds the value adopted or assessed or assessable by the stamp valuation authority. The value so adopted or assessed by such authority shall be taken as full value of consideration. Wait. Now, come forward. Not here. Yes. We will go to those 3 case laws for the 3 provisions. Yes, sir. This is first one. We will check that. Retrospective application of tolerance band of 10% to 50C. Why the safe harbor of 10% should be retrospective? Now, Finance Act 18 has with effect from 1st of April 19 inserted third proviso to 50C, which provides for a tolerance limit of 5%. That limit of 5% was increased to 10% by Finance Act 1421. Question arises whether the tolerance limit is prospective from the date of its introduction or is it retrospective. If it is retrospective, it is from when then? So, you see that host of judgments, Sandeep Patil, Bangalore bench, Maria Fernandez, Mumbai, Mamta Divakar Shetty, then Amrapali Sinimas, Delhi Tribunal, etc. They are telling amendment made in the scheme of 50C1 by inserting third proviso and by enhancing tolerance band for variations between the stated sale consideration vis-a-vis stamp duty valuation from 5% to 10% are effective from the date on which 50C was introduced with effect from 1st of April 2003. All these judgments you can use. Our Bangalore bench itself has given a beautiful judgment. You see this Sandeep Patil, Bangalore bench. What are they telling? Example. We also noticed that the Parliament introduced third proviso as per which difference in stamp valuation actual consideration should be ignored if less than 5% or 10%. Even though this said provision of 5%, 10% came into effect from 19 or 21, we noticed that the Calcutta bench of tribunal has held it to be curative in nature. In the case of Chandra Prakash Junjunwala, accordingly held that the proviso shall apply since the date of insertion of 50C. Accordingly, above said reasoning given by Calcutta bench of ITAT also supports the contention of the assessee. Therefore, we direct the AO to ignore the difference between the fair market value determined by the CAT appeals and actual sale consideration, as the same is less than 10% of actual sale consideration. About that, 50C2 to be invoked by the assessee. Now about 50C2, that claim you have to invoke. What is 50C1? You know that. 50C1, it deems that the stamp duty guideline value is the sale consideration. Therefore, this one is a rebuttable presumption. You will tell, no, you are telling stamp duty is 1 crore. According to me, it is 80 lakhs. Therefore, I went to the assessing officer to make a claim. Now they are telling 50C2 has to be invoked by assessing. Fine. Next, though 50C2, is there any procedure? Next, you are telling me to make a claim before assessing officer. They are discussing, have you got any procedure? Should I fill up any form? They are telling, no, there is no need to fill up any form. You make a normal claim. 50C2 does not lay down any specific mode in which the stamp valuation is to be disputed. It is better to have valuation done by an independent registered valuer, fair market value, get the valuation report. AO is not an expert in valuation as held by Ajmal Fragrances and Fashions. It is incumbent upon the AO to refer the valuation to Departmental Valuation Officer, DVO. Now, reference to DVO, whether mandatory, I made a claim before the assessing officer. First of all, I am telling today when you make a claim before assessing officer, it is a phaseless assessment. How will you make a claim? Sir, I am a practicing chartered accountant. This is the book, this is the theory, this is the practice. Very beautiful, all section, all case laws fine. You are telling me make a claim before the assessing officer. Can I approach the assessing officer? It is a faceless situation. What to do? ITR. She is telling how to make a claim. Make a claim in the income tax return itself. In the income tax return, as she rightly pointed out, I will calculate my consideration as 80 lakhs instead of 1 crore. I made a claim in my ITR itself. Something else you are telling, sir? In ITR.
ITR will not accept it, sir, more than 10%. Yeah.
ITR will not accept it.
Not valid.
If it is more than 10%.
It will not valid.
Achha. So that means in our example 80 lakhs is the fair market value, 1 crore is the guideline value.
Yes.
It will not accept.
Software will take 1 crore.
Software will take 1 crore only.
And TDS problem also.
Pardon, sir?
TDS also.
TDS.
The other party, the buyer would have booked would have been forced to pay TDS on 1 crore by the stamp registrar instead of 80 lakhs. So TDS also will show 1 crore.
So 190 for IA you are telling
Yes.
that more than 50 lakhs 1%. Okay. Despite all these problems, we have to make a claim. Despite all these problems, these are all practical problems. I am telling you, despite all these problems, we have to make a claim. So what to do? As you rightly pointed out, the ITR will not allow me. So what I have to do? I have to, what is that?
You have to apply to the ITO.
Jurisdictional ITO, I write a letter.
Yes.
I will write a letter to the jurisdictional ITO. I will also make a petition before the Honorable PCIT. My PCIT I will make a letter. In turn I will tell him, you please inform the, pardon sir? If at all there is an intimation etc. Against that intimation I try to file an appeal also. Intimation is appealable. So I have to try to make things work now. Because these are the practical problems. But I have to make a claim. In a return I have to make a claim. Yes sir?
No. I have a practical thing.
Yeah.
People staying in Bangalore,
Yeah.
they sell something in Kerala, suburban area. Nobody knows the stamp duty valuation.
You have to go there
No,
and
no,
certain.
sir, how? They just give us the deed, sale deed.
Yeah.
What we do is we write the sale value and we write the stamp duty valuation as same as the sale value.
Okay.
There is no way that assessing officer can check or
Can't you
can check.
interpolate the rate of stamp duty paid vis-a-vis the consideration?
Yes, yes.
How?
On the back side, on the
On the
same
back
side.
side. Pardon sir?
Actual consideration is more than
No,
stamp duty.
consideration is
Consider
more.
Stamp duty on the
Stamp duty is on the consideration. So you cannot, in any way you cannot find out.
Then he is telling I will not make a claim at all. Because I cannot find out.
No, you just make the stamp duty valuation
Yes.
within 10% range or the same rate as whatever the sale value is.
In order to fill up the return you are telling.
Yeah.
Basically.
Yeah.
To validate the return.
Fine. So let us come to our issue, sir. Reference to DVO whether mandatory. AO is bound to make reference to DVO if the assessee makes a claim that the fair market value of property transferred is less than its value as determined by stamp collection authorities. Fine. The word may in 50C2 should be read as should. For that there are case laws. Earlier you know that valuation officer was in Kormangla. What is that building? Pardon sir? Kendriya Sadan Kormangla. So the word may in 50C2 should be read as should. If section 50C is read to mean that if the AO is not satisfied with the explanation of the assessee, then he may or may not send the matter for valuation DVO. Then as we discussed, the provision itself would become redundant. Because he will always tell, no, my valuation is correct. Karke. Host of judgments are given.
I just have
Yeah.
a solution to the issue which he has.
Which one?
The difference.
The difference of 10%, yeah, tell me.
So in one of my clients' case, what had happened was the stamp duty was really high, whereas the property market value was low.
Yeah.
So before they got the property registered, they had it valued from the sub-registrar itself, and they give you a certificate. I don't recollect the form number.
See, the problem is, what is the telling? It should not be in dispute. You should not refer to any court reference to any authority. Did you refer to an authority? Then assessing officer will not refer your case. If you see that section, what are they telling? It should not be in dispute, and you shouldn't have referred to any court or any authority. You should not file an appeal, etc. So there, I agree with you. You would have filed, with the sub-registrar, etc. He would have taken that value, would have reduced that value. In fact, in between, you would have given that value. Little bit will be more than sale consideration, but little less than the stamp duty valuation. That is what you would have done. Fine. That anyway, you have got the relief also directly. So here they are telling, sir, the word may should be treated as shall once the assessee objects to stamp duty value as held in host of judgments. Clause A and Clause B of subsection 2 of 50C are in continuation to each other. Therefore, conditions laid down in both clauses are required to be satisfied. AO has to refer the capital asset for valuation to DBO only when there is a claim made by assessee. If there is no claim, AO need not refer the property for valuation. Now, next issue for valuation. In case where fair market value ascertained by DBO is less than value adopted by stamp duty authorities, then AO has to adopt the value ascertained by DBO. You are getting a benefit. Next, departmental valuation report is binding on the assessing officer as held in host of judgments. Hence, where the valuation of DBO is less than stamp valuation, it will not be open to AO to take stamp value as sale consideration. To that extent, you are getting benefited. Is DBO entitled to hearing if the assessee objects it? Now again, I will object to the DBO's valuation report also. They are telling, Bombay High Court is telling, valuation officer is constituted as an independent and distinct statutory forum for resolving controversy regarding determination of the market value of the property with all necessary powers. Its order or report is made binding on the AO and thus enjoys equivalent status. As per the statutory scheme, when the report or order of valuation officer under section 50C2 is objected to the assessee, then the CAT appeals or ITAT are obliged to extend an opportunity of hearing to such valuation officer. Even now in the course of your assessment proceeding, faceless, you have to object in the course of proceedings only. Then definitely your case will be transferred. And because there are 4 officers, assessment unit, then verification unit, then technical unit, then review unit. So, as and when you object, your case definitely they will transfer it to the valuation officer. They will transfer it out. You have to make a claim, and the claim can be made in the course of assessment proceedings. There is no doubt about it. So, against the valuation report also you can object, and then assessing officer will make an addition based on the valuation report. Against such an order, you can file an appeal before the CAT appeals or before the ITAT as the case may be. Whether the report of DBO is binding on the appellate authorities, it is binding on the assessing officer. But the report of DBO is not binding on the CAT appeals, also not binding on the tribunal. Yes. Now about that last issue. Whether that proviso specifying date of agreement to be taken for stamp duty valuation can be applied retrospectively. First and second proviso to 50C1 were inserted by Finance Act 16. That is your date of agreement, date of registration. Can I apply this to retrospectively? Specifying that stamp duty value of the property may be considered on the date of sale agreement instead of date of actual transfer of the property. Question arises whether these provisos can be applied retrospectively. Now, yes, the courts are telling you can apply this retrospectively, and it applies from the date of inception of 50C from 1st of April 2003. Kishore Hira Bhandari, for example, here Mumbai ITAT. Then Dharam Shibai Somani versus ACIT, ITAT Ahmedabad. Based on this ITAT Ahmedabad, several decisions have been given now. Amit Bansal case, Delhi Tribunal, Devendra Mehta, Rajkot Tribunal, Gold Garg Finance Limited, Mumbai Tribunal, Hari Mohan Das Tandon, Allahabad Tribunal. So, and again Vishakhapatnam Tribunal, Chalasani, Nagaratna Kumari, everybody has read on this Dharam Shibai Sonani versus ACIT, ITAT Ahmedabad, saying that proviso to 50C1 and first proviso and second proviso are retrospective, can be applied retrospectively, that is from the very inception of the section. Now, can 50C applicable in case of transfer of agricultural land? Sir, today faceless assessment is there. How do you prove it's agricultural land, or rural agricultural land, urban agricultural land? Agricultural land, you have claimed exempt, sale of agricultural land. 50C applies to rural agricultural land or not, or it applies to urban agricultural land. What is an agricultural land first? 2 is in bracket 14, subclass 3, 2 is in bracket 14(3), A and B is there. Don't get confused. What is A telling? A is telling I am within the jurisdiction of the municipality. I am inside the jurisdiction, A is telling. When I am standing inside the jurisdiction, population should be less than 10,000. A is telling I am within the jurisdiction of the municipality, population less than 10,000. I go outside the jurisdiction. When I go outside the jurisdiction, up to 2 kilometers, up to 6 kilometers, up to 8 kilometers, 10,000, 1 lakh, 10 lakhs population. From the jurisdiction, from the end of the jurisdiction, up to 2 kilometers, from the end of the jurisdiction, from the end of the municipality, up to 2 kilometers, then up to 6, up to 8, 10,000, 1 lakh, 10 lakhs, etc. So the whole idea is 50C cannot be applied if it's because it's not a capital asset basically.
Yes.
If it's a rural agriculture land, it is not a capital asset. And how should you measure the distance? It should be measured only aerially. How to measure aerially now? How to measure aerially? Go helicopter, put that trend. Now in this phases assessment, they are asking, you give me the GPRS. Go to your land, stand there. Your land only, not others' land. Stand in your land. Then Google Maps, longitude, latitude. Take everything, all those details. Take those details. Google Maps can measure that, sir. I sat with a brilliant AC now. That is what he told. I went there, I stood there. Then Google Maps, I saw history is there. Last 2 years, 3 years, was that an agriculture land? All the details comes. He reproduced all that in assessment order made addition. That's what they are doing now. They went there, Google Maps, they measured beautifully. I am getting certificate. See, earlier I used to get the certificate. Invariably, all agricultural land are beyond 8 kilometers. Agricultural land is beyond 8 kilometers. So 143 used to come, happily we used to go to department, agricultural land, certificate, finish, bye, over. Fine. Now sir, any time they can find out your agricultural land. Satellite maps are there now. You can't today bluff. They are going to ask those details. And the orders are being passed by relying on this. The assessing officer will put that, pass an order, 5-page order. No, this is not a rural agriculture land, urban agriculture land. Then 270A, you know, 270A9 or 270A3, underreporting of income, misreporting of income. Underreporting means 50%, misreporting means 200% of tax ought to be evaded. So this is the practical problem. Penalty under 271C is not leviable in the event an addition is made to total income merely by invoking 50C. There are 20 judgments, sir, don't worry. They are telling you made the addition merely based on 50C. No penalty under 271C in the erstwhile regime can be invoked. Similarly, you take that and try to incorporate that even for the 270A penalties. Host of judgments are there. Sir, 50C, does it apply when involved property is compulsorily acquired by government? Compulsorily acquired by government. And compensation is given and compulsorily acquired by government. The court noted that this was not a case of transaction between two private parties where there can be room to suspect. Justice Hiranmay Bhattacharya penned down concurring but separate reasoning on this issue by bringing out finer distinction between language of 50C and section 2 within bracket 47 by holding that the term transfer used in 50C has to be given restricted meaning and it cannot have a wider connotation so as to include all kinds of transfer as contemplated under section 247. It was held that the provisions of 50C shall be applicable when only when the transfer of capital assets has to be effected upon payment of stamp duty. Government is acquiring, no question of payment of stamp duty. Transfer by way of compulsory acquisition, the capital asset vests upon the government by operation of provisions of relevant statute governing such acquisition proceeding and subject to the terms and conditions laid down in the said statute being followed. In the case of compulsory acquisition, very important, transfer of property takes place by operation of law and these provisions of Transfer of Property Act or Indian Registration Act do not have any manner of application to such transfer. Therefore, the question of stamp duty payment does not arise in such cases. Again, here it is one more issue. So, exemption under 54, 54F, 54EC, 54, 50C. Now, for example, Ramchandra sold a property at 80 lakhs. Stamp duty value of the property is 1 crore. He claimed the exemption under section 54. What value would it have? 1 crore or 80 lakhs? Ramchandra sold a property, actual sale consideration is 80 lakhs. Stamp duty is 1 crore. He claimed exemption under 54, invested in a residential house within the time, 1 year before the date of transfer or 2 years from the date of transfer, outright purchase a house, or within 3 years from the date of transfer, purchase a land, construct a house, etc. So that calculation will be based on 1 crore stamp duty valuation or 80 lakhs actual consideration received. What is your opinion?
Money received.
Money received only. Deemed sale consideration. One opinion is telling actual money received, one is telling deemed sale consideration. There can only be 2 opinions because stamp duty or actual. Now think over how can Ramchandra invest 1 crore? How much has he received? 80 lakhs. How can he do the impossible?
He has to pay the tax for 20 lakhs.
Pardon, sir?
He has to pay the tax for
20 lakhs. You are telling he will pay tax for 20 lakhs. That means that 54F can be claimed with reference to 1 crore or 80 lakhs?
1 crore.
1 crore. Huh? Judgments are there now. 4 judgments are here. 4 judgments are there. What are they telling? The deeming provision fiction as provided in 50C for computation of full value of consideration is to be applied only to section 48. Deeming provision that 1 crore applied to 48 for determining sale consideration. But when you are calculating that exemption, what you will apply? Actual sale consideration. Because courts are telling you can't tell him to spend more than what he has received. He has received only 80 lakhs.
Balance should be black money.
That we cannot discuss. Or you have to ask Ramchandra only, sitting here only. What did he do? So here, Sunil Miglani's case, DCIT, Ghaziabad, Delhi Tribunal, what are they telling? Anand Chetan Agarwal, Lucknow, okay, yeah. This will be clear. Assessee cannot be expected to do more than whatever he has received. Meaning thereby assessee can invest that amount only which has actually physically received from transfer of long-term capital asset other than residential house as provided under section 54F. There is a doctrine of impossibility of performance wherein it is only to the extent of funds available with the assessee that he can be expected to invest. This view has been adopted by various judicial pronouncements like in the case of National Aviation Company of India versus DCIT and Jagdish Malpani by Indore bench of tribunal, earlier was Mumbai bench. Similarly, other judicial pronouncements are there, including Gauli Mahadevappa, Bangalore tribunal. So these are the various other judgments.
That means he has to pay tax on 20 lakhs.
Yeah.
So 80 lakhs you claim exemption.
Yes.
What happens if I make investment of actual 1 crore?
Correct. If you have made investment of actual 1 crore also, that formula will come now that proportionate. Actual sale consideration I received, I will take 80 lakhs out.
Even if I make an investment?
Even if you make investment of
still it will be restricted.
Because what I am supposed to invest is only 80 lakhs, which is restricted to my net sale consideration. Rightly is asking, I have made investment of 1 crore only. 20 lakhs is out of my legally declared funds. Still the section is telling I am going to give only to the extent of 80 lakhs. Any other questions, sir? 50C? Any other question on 50C or your 43B clause H?
10% benefit.
What, sir?
This 10% benefit,
Yeah.
I don't think it is not applicable for the 56, right? In buyer's act. 56, IFRS.
No, 10% come again?
In buyers and
56 to 10.
56, I don't think it is.
No.
It is only
See, up to 10% they are allowing.
in 56 also.
So what is he telling is, now he wants to involve 56 to within bracket 10. Very interesting. So 1 crore is the sale consideration, actual sale consideration. Stamp duty value is say 1.5 crores. Now 10% only we'll have to take, no?
Yeah.
Pardon, sir?
10%.
10% only. So that band you are getting, up to 10%, even they will not invoke 56 to 10 also. 56 to 10 cannot be invoked because of that 10%. Actual sale consideration is received less, no? The seller,
No,
50C when he has sold the property.
The buyer,
Now buyer has given less only, no? What is received is 80 lakhs only. Stamp duty value is say 1 crore, difference suppose it is less than 10%. What is the actual receipt? When is 56 to 10 applicable is, suppose I purchased a property costing which is 80 lakhs, stamp duty guideline value, I purchased at 50 lakh example. Then I got 30 lakhs discount. So that 30 lakhs is nothing but tax on other sources and 56 to within bracket 10. If it is within 10%, they cannot invoke 56 to 10 because section is telling 5% and 10%.
in 56, section 56, it is very categorical that inadequacy should not exceed 50,000.
Okay, you mean to say that more than 50,000 only?
Yeah, that inadequacy should not exceed 50,000.
10% and 5% not applicable there.
Not applicable.
You have an act there, just check that sir amendment is there or not. 56 to 10. Act is there, you have to check up. Correct, valid point.
56 to 10 is not applicable, it is within 10%.
56 to 10 is telling that provision has also come there.
Yeah, come there. Yesterday I
That 10% is there sir, 56 to 10. Correct.
Both places have.
So it is not only there in 50C, that is also there in 56 to 10.
56 to 10 also.
Then okay, no problem.
10%
It is there.
That leverage. It is expressly.
Yeah, expressly stated. Correct. That was the doubt because he told that more than 50,000 there. So we were on the impression whether that clause is there in 56 to 10 or not. It is there.
In one example,
Pardon sir, yes sir.
say the guidance value is 1 crore,
Okay,
the actual consideration is 80 lakhs.
fine.
The matter is referred to DBO.
Actual consideration is 80 lakhs.
The matter is referred to valuation office.
Fine.
Departmental. He has put the market value at say 87 lakhs. Okay. So now what will be the sale consideration here? 87 lakhs.
Fine.
But I think we should take 80 lakhs only because 80 lakhs plus 87 lakhs for 10% variation. So we should take 80 lakhs or 87 lakhs.
That 10% is of only actual sale consideration. 110% of actual sale consideration. This is the consideration determined by DBO. 87 lakhs is the consideration determined by DBO.
Correct.
I have to take how to calculate 110% is of the actual sale consideration.
Correct. So now 80 lakhs plus 10 lakhs means plus 10% means 88 lakhs it comes. The
Actual sale consideration.
Yeah.
Fine.
So valuation determined by valuation officer is 87 lakhs.
So you are telling I take 87 only.
I should take 80 I mean.
No, 87 need to be taken for consideration.
Pardon sir?
87 need to be taken.
87 for consideration. Correct.
Even consideration 87 only need to be taken. Because
So they are not get this 10%.
No, there you are not going to get.
No, probably here it will go for undervaluation. Once it is determined by the DBO as 87 lakhs, then that time only has to be considered.
Okay, you are telling again it has to refer to DBO basically.
Yes.
Then DBO it is. So these are all various things, sir, and this claim before the assessing officer is slightly tricky. As I have told you, in the course of assessment proceedings only you can make a claim online. They will definitely transfer the case to the verification unit here. And verification unit in turn will transfer it out to your jurisdictional assessing officer, who only for the limited purpose of getting the valuation report is going to tell, then they will upload that report also now. That valuation report also they will have it uploaded. Because I don't know, standing here in Bangalore, my SSC, I don't know who is doing the valuation. I mean who is doing the assessment. He may be in Delhi, Bombay, Calcutta, etc. That fellow will refer to the verification unit of the concerned and verification unit will refer the case to the jurisdictional assessing officer, get the valuation done, and the valuation report also may be uploaded also. They will tell file your objections online.
Even registrations will not happen.
What sir?
If the value difference is there,
Value?
value differences are there.
Yeah.
stamp duty value.
Registration also will not happen, you are telling, unless they collect the full stamp duty.
They will go for DR, the DR. So
Correct.
they will be referred to DR.
Yes.
Then DR will decide whether based on this valuation, whether property value is correct or not. Once that is decided, then it will go back to register the property with this value. Which is
Correct, that's what she told, no? Outside the street, you got it settled, that's what it was referred to DR. Correct.
Sir,
Once
but
it is referred
practically,
to DR, that value will be.
Fine. Yes,
so
sir.
let's take same example. Practically, 80 lakhs is the actual value.
Okay.
1 crore is the stamp duty value. Stamp
Fine.
duty authority say no, we are correct 1 crore. So if suppose buyer now pays stamp duty on 1 crore, but actual registration has happened only for consideration showed 80 lakhs. What is the case?
So buyer paid stamp duty on 1 crore.
1 crore.
Unfortunate, sir. You paid on 1 crore, so what to do? Both of them will suffer. Buyer 56 to 10. Because 1 crore property,
So but practically
you gave only 80 lakhs. And 50C anyway, you sold 1 crore property at 80 lakhs. Double taxation you can't tell, there is no case law here. 20 lakhs in the hands of buyer under 56 to 10 under other sources. And here in seller's hand 50C as capital gains.
So but practically today's scenario, Karnataka stamp duty authorities don't even reduce 1 rupee.
Achha. So as he told, they are telling without payment of stamp duty you cannot move further at all.
They are not giving. They are telling you check other things. But
Somebody has to
duty value is
register
correct.
property or sell the property, they will not refer the matter by you reduce the value. They will take months to consider the valuation. Nobody is going to
TDS
wait.
provisions have been changed.
Pardon, sir?
TDS provisions also have changed. Now we have.
194 IA.
Yes.
1%.
It is done on the guidance value.
Oh.
It's not, earlier we used to do consideration to it, but now need to be done whatever the value. Which
Only on the guidance value you are telling, 194 IA.
Yes. That need to be applied.
Sir, that they have extended to such an extent, even if some NRI is selling, they are telling on the headline value only you deduct the TDS and show us.
Not on capital gains, sir. On gross sales consideration.
Yeah.
Gross sales consideration.
That is other selves pay. Only.
Yes, sir. Any other questions, sir? 45 5A 50C or 43B clause H. 43B clause H, tell me.
So in case of 45(5)(a),
Yeah.
so if 60% is a developer will take the share of the land, develop the building.
Yes, sir.
40% landowner will take a building. So I will offer for 40% of the building construction as for the sales
Correct.
consideration.
In the year of receipt of CC.
Can I claim one of the property as a 50F?
Definitely. 100%. 54, 54. Definitely.
Same
You will
property.
get it, no problem. So when you claim that, what I am telling you is in the year 5 you would have claimed.
Correct.
So there again we have to dispute based on that board circular. In this also board circular will come.
But the value should be considered stamp value only.
Correct.
So in the same example,
Yes, sir.
if you have to go for 54F, there is a inherent condition that you cannot have more than 2 houses at the time of transfer and all that. So if I am getting 40%, it invariably is more than 2% to a number of 2 houses.
Okay, as on the date you are telling not more than one house. That condition, subject to the conditions basically.
So again 54F?
Not possible. Subject to the conditions, because in 2014 that amendment came. When Arun Jaitley, gave the first budget under the NDA regime, this amendment came in 2014, first budget of NDA government under Arun Jaitley. He brought the 2 amendments, ONE one house. He made it one house. Then he also added the word in India. Earlier that in India was not there. I used to, sell house here, invest in Sri Lanka example, or invest in USA. I used to claim here 54, 54F. At that time there was a. Now he has become Joint Commissioner. I think Shivanand Kalkeri was there. I remember that because he had disallowed that in the assessment order. Because property was sold in India, invested in US. So Shivanand Kalkeri now is probably Joint Commissioner or Commissioner. At that time he was ACIT. He disallowed. He told what is the concept of 54F? In order to give a boost to housing in India, you are selling here, investing abroad. I will not allow Kalkeri. You don't allow, sir. What is the Act telling? Act never told in India at that time. So then when this amendment came, he called up. See, Naveen, my judgment, although you won in tribunal now, because of this judgment, amendment is made in Finance Act. Very fine gentleman, I just remembered his name because of that example. So one residential house in India is added. So basically, and my presentation is also there, so on 54F. There are some 32 issues I raised. 32 issues on 54F. And all the judgments are in favor of the appellant, are in favor of the assessee. That you will get it on this with CTC of the Chamber of Tax Consultants Mumbai. If you can log in there, 2-hour session is there. 32 judgment, 32 issues on 54, 54F, all case laws which is uploaded in favor of the assessee.
So,
Yes sir, any other question?
I have a question 45.3 and 50C.
45.3 and 50C, outside today's topic itself. 45.4, you should, now 45.3 sir, all the tax planning is gone. Why? Every damn thing they are telling at guidance value only now. You take your 45.4 and your
9B.
45.4 and 9B. Very, very important, 45.4 and 9B. None of us have, bothered to check that 45.4 and 9B. What has happened?
My question is,
Yes, sir.
shall I ask, though it is out?
Yeah, please.
See, 45.3, what it says, any transfer of property we have bought now, whatever the value recorded in the stock,
Those.
should be considered as a consideration. Suppose the assessee, the partner transfers some 1 lakh rupees and the 50C value is 1 CR. How does it?
Not possible, sir. It is 1 CR only now. Today's case 45.3 is not possible at all. It is 1
The
CR.
45.3 over its 50.
Yes. No. Don't do that tax planning at all. It's all guideline value. See, earlier, these company shares were there. Companies having immovable property, unquoted shares of the company. What we used to do, transfer that shares. And that property will cost 1 crore, example. Shares I transfer it out at 10 lakhs. Now all gone. That 50 CA is introduced in the statute. That unquoted shares also, that if there is immovable property, you have to transfer only at the guideline value. Not possible at all. All those tax planning have been nipped in the bud, sir. Don't even think now. 45.4 9B has come, they are telling on reconstitution itself, whatever amount, extra amount you receive in the case of the partner, several Supreme Court judgments were there. Several Supreme Court judgments, they are telling what 45.4 and 9B. What is 9B? Capital asset or stock in trade. If a partner receives capital asset or stock in trade, in connection with dissolution or reconstitution, suppose your capital or stock in trade, your capital asset stock in trade, pay tax. Here 45.4, what are they telling? Partner is receiving money or capital asset. On what? In connection with reconstitution. What is the meaning of reconstitution? Either retirement or admission or change in profit sharing ratio. Suppose the partner is receiving money or capital asset. How to calculate? A is equal to B plus C minus D. What is A? Capital gain. What is B? Money. Plus C. What is C? Fair market value of the capital asset. It is fair market value. Minus D. What is D? Capital standing to the credit of the partner as on the date of reconstitution. Whatever that amount is there, that will be taxable in the hands of the firm, not the partner. You have to be careful. Therefore, if there is a reconstitution, in the case of a partnership firm, there is a reconstitution, 45.4 you have to apply when? If the partner is receiving money or capital asset. Therefore, to the extent of capital only, you please pay him. Suppose capital is 1 crore, if you were to pay him 2 crores, then the firm has to pay tax on that 1 crore additional, whatever you paid. You have to pay tax. Suppose you gave him an asset, capital asset, value is 2 crores. That is why they gave that formula 45.4. A is equal to B plus C minus D. What is B? Money. Plus C is capital asset, minus D capital outstanding to the credit of partner. Very important. Go further. 45.4 you are applying. Suppose you paid 40 lakhs more. 40 lakhs firm paid tax. Firm is questioning what is the benefit you are giving me. 40 lakhs you made me pay tax. Asset was given to whom? Partner. It is like TDS. Firm, what is the benefit to the firm? Therefore, the rule is telling, rule 8AB. What is the rule telling? That 40 lakhs, whatever you pay tax, you please apportion it to the remaining assets of the firm. Please apportion to the remaining assets of the firm. In what ratio? In the ratio of the increase in revaluation of the remaining assets on the date of reconstitution.
If there are no assets,
then section fails. Please understand, sir, it's not a matter of joke. How to apportion that 40 lakhs, how to apportion, how to distribute. 40 lakhs will be apportioned to the remaining assets of the firm. In what ratio? In the ratio of the increase in revaluation of the remaining assets on the date of reconstitution. Suppose 2 more assets are remaining. One is a capital asset, one is a depreciable asset, one is a land. One is depreciable asset, one is land. That 40 lakhs, 45.4 I calculated, 40 lakhs I paid tax. How to pay tax? How is it long-term capital gain or short-term capital gain? How to calculate that? Is it long-term or short-term? That also, it is what? It is based on the character of the remaining assets. Suppose the remaining asset is a long-term capital asset, pay taxes long-term. Suppose the remaining asset is a depreciable asset, then pay taxes short-term. And the rules are telling self-generated goodwill, self-generated asset, or your depreciable asset, you have to calculate as short-term capital. So this is nothing but sum and substance 45(4)(9). 9B is very simple. 9B, what are they telling? You are giving stock in trade and you are giving capital asset. So it will be tax, capital gain, regular provision 45(1), and stock in trade is under section 28, business profit. There you can't allocate or distribute or apportion. When can you apportion, distribute, allocate? Only when you pay tax under 45(4), not under 9B. So 45(4), be careful. This you have to apportion to the remaining assets as and when the remaining asset is sold. For example, here I told one land is there. Increase in revaluation, I apportioned that 40 lakhs. That land is sold in future. Then whatever you apportioned here, you have to reduce it from the sale consideration of that land sold in the future years. And unfortunately, as you told, if there is no asset, then it goes waste.
And in case retirement.
Retirement also there, no?
Retirement, if the partner settles outside the books of the firm.
Outside the books means what?
In the sense like.
His capital is there, sir. Have you settled the capital or not?
Firm is not settling.
Firm is not?
Settling.
Then he has not retired now.
Incoming partner is settling. Say my capital is 5 crores. If you pay me 5 crores, I will be introduced.
If you pay 5 crores, finish, nothing to worry. What to the extent of his capital you pay, no question of 9B, no question of 45(4).
But firm will not pay anything. But you would have paid even 6 crores, 10 crores. But it goes in a personal account. Then what is the impact in the firm?
No question of any impact, sir. To the extent of capital, have you paid more or less?
Firm is not paying anything.
Finish, matter ends there. Firm is not paying anything, no question of invoking 45(4) or 9B in the firm's hands.
Because that transaction itself, firm is not paying.
Now the capital is 5 crores, sir, of the retiring partner. That fellow retired. Okay, it is there in the creditor now, 5 crores payable. That's all. So firm has not paid to him anything, example. Therefore, no question of invoking 45(4) or 9B. Only when it's paid more than that. Suppose this tax planning is done 5 crores is payable, I will pay after 2 years 6 crores. That means what? When it will be taxed? It will be taxed in the year of receipt. As 45(4), 9B, don't think you can escape. Because the law is telling in connection with transfer, in connection with reconstitution. So in connection word is very big. 2 years you will keep payable, third year will make payable, not possible. Third year when you pay, it is taxable 45(4), 9B.
Sir, in the given example, what is said, if firm is not paying, then it will be still showing an outstanding liability in
That's all. So there is no question of 45(4), 9B. I am taking it further.
Then sometime it has to be closed in the
That's what I am telling, sir. I am telling the firm will make payment after 2 years and they will pay 6 crores. You will tell, no, reconstitution happened 2 years back. I am making payment today. Law is telling in connection is a wide encompassing term. As and when you make payment, to the extent of capital, if you make payment, no problem. If you pay a penny more, apply 45(4), 9B. You will have to pay tax, no way out.
On the date of reconstitution, if the partner has debit balance, that particular partner has debit balance.
Fine. That means you have already paid him much before the reconstitution, not in connection with the reconstitution. Debit balance is there when? Not on reconstitution. Before that itself there was debit balance.
Sir, suppose I say the capital outstanding every year until you make the payment as interest.
Pardon, sir?
Interest on outstanding. Then after 2
That's
years
okay.
they make the
You
payment.
put interest, no problem.
After 2 years they make the payment.
Whatever, sir, that capital is more than this. Whatever amount you are making payment is more than his capital. Then 45(4), 9B will be applicable. You cannot tell that the garb or you cannot hide that I paid only interest. Their law is telling that was a capital. You paid much more than capital. You can't tell I paid interest, therefore it is not taxable under 45(4), 9B. Department will not accept that contention. GAR will come, chapter 10A. Be aware of GAR. Chapter 10A. Any other questions, sir? 45(4), 9B or 43B clause H or 50C or 45(5)? Before we close down.
From the 45(5) case may, so the provision told that one, this 45(5) is not applicable when the transfer happened before the CC comes.
Correct.
So the transfer means...
No, 45(5) proviso is applicable if the transfer happens before the CC.
That means we have to go for regular provision?
Yes.
So regular provision is applicable to me. So if I example 40% I get 4 flats, before getting CC I already identified the customer, I made an agreement. Is it considered transfer?
That is second transfer. First transfer is what? When you receive the constructed area, pay tax. You identify the customer and you sold that property to him. Second time you have to pay tax.
So,
don't think there is only one tax. That's why I told normal provision 2 times tax.
So in this case,
That means, sir, you didn't receive in the year of CC, you received before only. Why? Because before that only you transferred. So when you transfer sale, fair market value or guideline value of that 4 flats, in future you are going to sell that 4 flats. That time what is the sale consideration will become the cost of acquisition that time. So there are 2 trenches that time.
but we cannot, even if we enter into agreement 45 I will not go, still I will be applicable for that.
No.
After they enter into the
When you sell, that means Suraj Land Shed, Supreme Court, only on sale deed, when execution, sale deed, when it's executed, then only you will have to pay tax for the second thing.
So, to follow up on his question, suppose sale or transfer happened 1 year, 3 years after CC came in.
Right.
Right, based on Karnataka High Court's, I took an indexation on the 3rd year. Now I made a sale in the 8th year. Now do I take the denominator indexation for the 1st year or from the 3rd year?
No. You have to take suppose you took the denomination of the first year, you already paid tax. Isn't it?
So on 3rd year I paid the tax.
3rd year you paid tax when you transfer the property.
No, when I got the CC.
Okay, when you got CC, that means 45 applied, you paid tax on the guideline value. And in future when you sold that property,
When I sold
that property, whatever tax you paid on the guideline value, that will become the cost of acquisition.
Yes, but for the indexation.
49.7.
Yes, for the indexation, do I take the year 1 indexation as a denominator or the year 3 indexation?
Year 3. Because in year 3 already you took year 1. When you calculate year 3, you took year 1 already.
That I did.
But anyway, the first year benefit of the land acquisition, you can take the benefit indexation only for building cost and take the 3rd year indexation.
Correct. So now you are understanding, you are making it workable. Don't tell it's not workable. Computations may vary. There is no problem. But I have to pay tax. No question of not paying tax.
So can first occupation also be deemed as CC if there is no CC?
What, sir?
If there is no CC in any case, any first occupation will be deemed to be completion.
So he is telling here there is no CC at all. So you have got the OC now.
Nothing.
Right?
Just occupied.
Pardon, sir?
Just occupied one of the building.
So department has to prove now that when do you pay tax then basically?
Yeah.
You have neither got the OC nor you got the CC.
But we have started occupying, giving it on rent, everything.
Yes.
So what will happen in this case is when the department proves that basically the department, suppose the builder is raided in this case, they cannot catch you here, but they can catch the department. The department can catch the builder. Suppose the builder is raided or searched, that time they will come to know he has already completed the project. They will ask for the details of customers. Then they are going to send 133(6) to those customers and with 131 summons. So this time what has happened in the department search, the 2 years back the DA changed his mind. He started, he started to search the customers rather than the developers. He started for landowners and his customers, like how you told here. So he tried this technique, and that time you may get caught. Directly department will not come to know, sir, because you have occupied. You are not sure, nobody knows, because neither you got CC nor you got OC, but they have handed over the possession of flats to you. You have also made the payment to him. That fellow offered on POCM basis, etc. Unless if the builder is searched, and then they are going to find out, yes, I have already handed over possession. Notice will go to the flat occupants also. At that time they may catch you.
Certain UPI payments treated as account paying.
100%, yes, 100% yes. Don't worry, that also you can take it, not an issue. That proviso will apply. Any other questions, sir? 50C, 45(5)A, 43B class H or 43CA? I think last 5 minutes we can stop. 43 CA, sir, exactly the same. You take this for example, 43 CA. Now here, basically what I am throwing here is before closing, 23.4, you know what is the section? 23.4. Forget 43 CA is a replica of 50 CA. It is only applicable in stock in trade, what was applicable in capital asset. What is 23.4? Or 23.3 or 23.5, basically 23.5. Deemed rental income. What is your opinion, sir? You are aware of the section 23.5. Suppose you are having some 50 houses in stock in trade. 50 houses. Within how many years I have to sell, sir? That development? Within 2 years. Suppose I am able to liquidate 20 houses. I am not able to sell that balance 30 houses. It is lying in my stock in trade. So what is 23.5 telling? Pardon, sir? Show notional rent under the head income from house property of stock in trade. It is held as stock in trade, but I have to offer deemed rent, notional rent under income from house property of my stock in trade. Earlier it was 1 year. Representative to Finance Ministry, they told okay, I increase it to 2 years. You have to be careful there because they are planning to reopen those cases. 148 ABCD. Builder has got 1,000 flats now. Can he dispose of everything? Can he sell within 2 years? Or they are telling, suppose you have let it out. Let it out also, they cannot catch you. Out of 1,000 flats, he sold 500 flats. 500 flats are still continue to be there in his inventory even after 2 years. You mean to say 500 flats, 10,000 per month. Into 12, 1,20,000 into 500. I will give you 30% repairs, 24A, interest on borrowed capital, balance you pay tax. But these provisions are there in statute, sir. It may become a case for reopening. You have to be careful there. All these provisions are already there in the statute. Anything to add, sir, on this 23.5? 23.5, you want to add anything?
Luckily, they have not asked us to qualify an auditor.
Pardon, sir? No, that is again matter of great danger now, grave danger.
If they ask us to qualify an auditor,
because I am notional rent, see, I am the chartered accountant of this, for example, Deepak housing. So 50 flats he has. So as he rightly told, no, I am not commenting on that at all. That 50 flats what is there in stock in trade, more than 2 years, I am not commenting on that at all in my notes to accounts also. Because is there any clause in 3CD first of all? Is there any such clause in 3CD? 44 clauses.
Possibly clause 16 in the governance, incomes not credited to penal account.
Incomes not credited to penal account.
This is not a normal income. This is a
Pardon,
deemed
sir?
stuff. This is a deemed stuff. So
Deemed income. This is a deemed income, notional rent.
Still income.
Still income, he says, you have to offer income.
and moreover, 3CD they say to income from business. So 23 will come under income from
house property. But that's why he told that any other income, no 16D, in that you qualify. So that form 3CD is slightly tricky. They are telling what for the business only. But in that he goes on to ask, for example, clause 17, he is asking about your capital gains. Blindly you tell, property is sold, put that information in 17. You should not put, he is telling only when you undersell that property. Below the gain and value, then you fill that. They will tell property sold, fill up clause 17. So you have no business to ask me to fill up clause 17 when I am doing the audit of the business. You can't ask me to give detail about capital gains. And you are asking me to certify also. So this is again biggest problem you are going to face is now 43B clause H. What will you do? That anyway 43B is there in that your form 3CD. How will you report? You have to report. Pardon, sir?
Disclaimer. You will give disclaimer.
Disclaimer is always there, sir, because he didn't give me this certificates at all. Who are all MSMEs? I don't know. Ultimately, it's the responsibility of the client to give me all the certificates. Who are all MSMEs? But I have been writing from last 4 years or 5 years that process of identify MSME has started. 5 years you are writing the same thing. We have started the process. When will you end the process? Law itself now has been implemented. From last 4 years, you know, we have started blindly, cut, copy, paste. 3 CD, what to do? 44 classes, nil, not applicable, nil, not applicable.
This class 17 could be like in where capital asset is being converted into trade. If that is so, then the realization of
No, that is not there in class 17.
There could be possibility where capital is being applied, so that where the company is not declared the capital gain and brought for tax, then that kind of transaction.
So here what is telling, any income not credited to penal account.
Yes,
That also is telling you declare.
Yes, that is what which is going to happen. Till the sale, we are not going to pay any taxes.
Correct.
Once it is converted into stock.
Quite.
So that question may arise. That reporting we may have to do when it is not reported as a fraud.
So be careful, sir. Last 2 minutes, sir. You have to get ready now. Inform all the clients. 40 class H. As of now, there is no board circular as of today. It may come tomorrow. It may not come also. It may be extended, whatever. We have sent representations. 7 seminars I took. I also requested the concerned officials there. At least inform madam to consider that 45 days and 15 days. Make it 75 days or 90 days. Or I also requested the government to extend that up to the due date of filing return. That proviso to 43B is not applicable to 43B clause H. Even if the payment is made before the due date of filing return, it will not be allowed as a deduction standing today. So we have told the concerned officials, you request them to extend this also. In fact, when 6 months back only during elections time, Piyush Goyal had come to this Vasvi in Baswangudi. At that time I told all the businessmen, at that time itself 6 months back I told, listen carefully, this provision will impact all of you. Straight away I told in front of Piyush Goyal, all the businessmen there, listen to this provision. That this provision will create mayhem in your business now, daily business. It will be very difficult for you to carry on the business. Now for example, Surat traders today, they are suffering a lot. What they are telling, buyer and supplier, first of all my sales now, all sales returns are coming because I am MSME. So now before March, all my sales are getting cancelled. All sales returns now. Because they are telling I don't want to purchase from MSME. And my in turn myself, I will have to make payment to the, all my suppliers are all MSMEs. So it's a double-edged weapon, double-edged sword, but the provision is already been implemented as such. There is no way out here. As a professional, what I can do? I have to save my skin. You have your own problems. Professionals, we have our own problems. I will have to identify. Tomorrow I have to tell the client to shoot mails to all your creditors. Point number 1, please shoot mail asking whether you are MSME or not. When you get MSME, you please make a column. Take that MSME number, put it in the ledger. Put that MSME registration number. Next is please identify whether you are micro, small or medium. Or if you are medium, I have no problem, I am least bothered. If you are a trader, I am not bothered. Retailer, I am not bothered. If you are micro and small, then please make those columns. Date of the invoice, date of delivery of goods. Then 15 days and 45 days, 2 days of payment, if there is agreement, when payment is made. And then the next column I have to write whether to add or not to add back. And also I have to take care that suppose this time they have paid, but belatedly if they have paid, next year I should be alert that this should be reduced from my statement of total income. That also I have to make sure. Suppose this fellow, poor fellow, he paid on the 47th day, example. He paid on the 47th day. So I have no choice, sir, I have to add back. Once I add back, next year I will have to claim as a deduction. That also I have to keep a track. And again this checks they are telling, I am paying by check. It's a post-dated check. So what has happened is, 44th day I issue a check. 45 days is the time limit agreement. 44th day I am issuing a check. That will get realized to say after 30 days. Yes. As per Negotiable Instruments Act it is 90 days, 3 months time. This check I issued on the 44th day. And it is realized within 30 days, next 30 days. But it is realized on the 74th day. No doubt about it, Negotiable Instruments Act, the date of realization of check dates back to the date of issue of checks. But here the department may not listen to me. They may tell payment is not within 45 days, though you have issued the check within 45 days. So your guess is as good as mine. I am going to tell now, check is issued within 45 days. Payment is cleared on the 65th day, example. No doubt the check is issued before the 45 days. So we don't know what stand the department will take. But as on the date of issue of check, there should be sufficient funds in your bank account that you have to take care. You have to see that sufficient funds are there in the bank account.
Sir, if payment is made before 31st of this year, then this.
Sir, during there may be delays, sir, no problem at all. The invoices are raised in April, May, June, etc. 100 days delay, 150 days, 200 days delay. Before this end of the year, if you make payment, absolutely no addition, sir. 45 days, 15 days will not apply. Only for those invoices which are being raised in March, fag end of March or in between, in beginning of March, there only that 45 days, 15 days comes into play, subject to the agreement. Those timelines are there. That you have to be careful. Can I purchase goods through DC, delivery challan? Is it possible?
Yes.
Without raising an invoice, can I purchase goods through DC? I can't stop my business. Okay, I want stock. So can I purchase goods through DC? Possible? I will raise the bill in April. Once you raise the bill in April, then it can continue for entire year, there may be delay. No problem.
Delivery of goods is
Pardon, sir?
Delivery of goods is there.
Delivery of goods. Yeah, delivery challan I am raising, sir. I am not raising an invoice.
Correct. For MSME, it is delivery of the goods. The date from which you have to calculate.
No, correct. Delivery of goods is there. There is no invoice, but purchases are not there.
But how do you account DC? DC.
Pardon, sir? Yeah, I am asking you. What is the position for DC as per GST?
There are no creditors.
There are no creditors.
Because of this.
Can I order goods through DC? There is an e-way bill, etc. It's small fine. There is no invoice raised, but.
Yes.
Pardon, sir?
How will the supplier?
No, what did you say?
It will hit your profitability.
Linked to your profitability, okay?
And how will the supplier account in this books?
No, see, what we are telling is, sir, they sale on approval basis. Can't I take goods on approval basis?
Yes.
This is DC, this is on approval basis.
Approval basis, then only on approval from that date, deemed date of acceptance.
No, that's what I am telling. If I take on approval basis, whether invoice has a role to play in 43B clause H or it has no role to play. That is the good question. What did you say, sir? Something you are telling?
It will hit your profitability because.
No doubt about it. Yeah. So these are all ways and means, and we don't know how the department takes a stand here. We may be doing all this tax planning, and at the end, what I am worried is I am not making an addition of this. So that liability you have to be careful.
The DC problem is reconciliation becomes difficult between two parties.
Reconciliation, okay.
But even one more thing is
Because he is not booking as a sale.
Fine.
But I am booking as a purchase.
Okay.
My stock will be raised and that fellow is not at all accounting it.
So in any organization, there is a GRM.
Pardon, sir?
In DC also you receive goods.
Okay.
There will be a GRM.
Okay, GRM is there.
Which any day can be tracked saying that on which date you are
Fine, then you are telling from delivery of goods, matters. Delivery of goods 15 days, 45 days. That's all. Fine, sir. Thank you. Thank you very much.
Members, let's wait for a minute so that we can give out thanks for the speaker. Yeah, I have one announcement to make. We have a half-day seminar on 19th. So it is a half-day program, Companies Act and Statutory Audits. And the speakers would be Vijay Rajavan with regard to IPOs, role of chartered accountants in preparing the companies for making them IPO ready. The other one would be Mr. Kamal Garg from New Delhi, will be totally taking of statutory audits. So please, I request members to register. The registration is available at the Bangalore Bank website. And I would also like to announce that recently the branch has been awarded the second best branch award at the CA level. Because of cooperation, your registration has made it possible. And we also got Sikasa Best Branch Award, second place. So I happens to be the chairman Sikasa branch, Sikasa. So I again congratulate you all. Your students have done really well. Please hand over a token of gratitude to our speaker.